The narrative is changing, and the facts are driving that.
There are deviations from the trend. The trend has been moderating.
It's good news that we have a strong labor market.
We are in a pretty good position with respect to productivity.
We expect the market to continue to rally into year end.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Getting your week started with equity futures on the S&P 500. Shaping up as follows, positive by 0.2%, coming off the back of the biggest weekly gain of the year so far. Bramo, the scores last week, the S&P 500 up close to 6%.
Do you buy it? This is going to be the key question this week, especially because we're not getting a whole host of economic data. Is this going to stick with some sort of conviction? Have we sort of gone across the Rubicon? Or is this an anomaly really set up by a lot of extreme positioning?
Barclays does not buy it. The team out with this note. Listen to this. This dovish turn may have backfired, with financial conditions easing significantly in the last week amid some softer data. We retain our view that data momentum will force another hike, that they acknowledge they're going to push that out from December to January. But can you imagine restarting the hiking cycle in early next year?
No, I can't. And I can't imagine it because really what we saw a reset of in all of the notes that I read over the weekend is finally everyone's sort of reviving their inner recessionistas and saying, actually, you really think that you could get the most aggressive rate hiking cycle in the whole history of modern finance and not get something breaking? Just wait. And that seems to be suddenly the comfort that people are drawing that they'd all ignored for so long as they were talking about the reacceleration of inflation.
Deutsche Bank, the Fed is done. Citi, the Fed is done. Rick Reeder, BlackRock, the Fed is done. And that's quickly become the consensus view after this big bond market reversal we've seen in the past 2 weeks.
What I don't think people have grappled with, and today we'll get the sense of that from the Senior Loan Officer Opinion Survey that comes out later today, and we'll go over that in a bit. We don't have a sense of what the pain has already been, especially of holding rates at 5% for this long. People have not imagined that because we don't have a sense of what the long and variable lags are that Jerome Powell sort of tried to reprise and sort of is this catch-all phrase for we have no idea what's going to happen.
Do we have a sense of the politics 12 months out from the election in 2024? Big poll coming out of the New York Times over the weekend. Big leads in 4 key swing states for the former President Donald Trump over the current President Joe Biden.
2 things. You read the details of this. This is a vote against Biden. This is not a vote for Trump. Any other generic Democrat up against Trump would win by 8 percentage points in this poll. Kamala Harris would do better than President Biden.
Which is kind of shocking.
Which is kind of shocking. You take a look at the internals of this poll, and what this means is people do not want a repeat of what they had 4 years ago. The question is, are they going to get it regardless?
52 to 41 in places like Nevada. Just jumped off the page for me over the weekend, Bramo.
And of course, Michigan, really front and center, given some of the pushback versus the recent, against some of the recent Biden policies. Honestly, this poll is going to cause a lot of hand-wringing. Whether this actually causes a different cast of characters heading into next year, I'm not sure.
We'll catch up with AMH a little bit later on this morning. She'll join us in the 7 o'clock hour. Let's turn to the price action, how we're set up this Monday morning. Equities on the S&P 500 pushing higher by 0.2% after a massive week of gains in the equity market, inspired by a move lower in bond yields. This morning higher by a couple of basis points, your 10-year 4.59. The euro showing some strength against the weaker dollar in the last week. Lisa, the euro against the dollar right now, 107.49.
That is shocking. It is not a 106 handle. It is a 107
no longer.
handle. Yeah, exactly. Today, what I'm looking for, and throughout this week, it is a quiet week when it comes to economic data. Today at 2 p.m., the Fed is releasing its Senior Loan Officer Opinion Survey on bank lending practices. This was the slews that everyone was talking about 3 months ago, suddenly very much front and focus because we've seen a bank index, a regional bank index, still flat on its back relative to where it was during the depths of the pandemic. Do we get a sense of how much credit is contracting? You talk about who the cast of characters is going to be, John. We get the third Republican primary debate on Wednesday at 8 p.m. in Miami. There is going to be a smaller crew this time. The potential members that are going to show up so far, Ron DeSantis, Vivek Ramaswamy, Nikki Haley, Chris Christie, can any of them replace the former president at a time when a lot of people agree that it is going to be maybe difficult for him to win if it is anyone other than Joe Biden running against him?
I'll wait for Anne-Marie's thoughts on this a little bit later this morning, but I think ultimately a lot of people just assume, and have done for many months now, that we consolidate behind one candidate out of the candidates that you just put up on screen, is that going to be Nikki Haley? Nikki Haley has the momentum at the moment, but who else wants to drop out going into Christmas?
And how much really is national security going to be front and center? And meanwhile, Fed Speak does return after the quiet period. Fed Chair Jay Powell is going to be speaking on Thursday. There are many others as well. Whether he clarifies the maybe misconception that the market has baked into the easing of financial conditions, we shall see. But all of this will have the drumbeat of $112 billion worth of 3, 10, and 30-year treasuries being sold throughout the week. The reaction of that might be more telling than anything the Fed chair says.
There is a lot of supply coming later this week, which is worth keeping an eye on. No doubt about that. Joining us around the table, Chris Ferro, partner and head of technical and macro strategy at Strategas, a bed company. Chris, good morning.
Great to be here.
Have we got the ingredients lined up, the recipe for some bond market stability?
You know, it's funny, as we were talking about as we came on, there is such confidence here across the street that bond yields have peaked. Right? Yields are off 40 bips from the highs. I think we got to see a little bit more to say with conviction that we're done with rates up for this cycle here. I mean, the trend in yields is 3 years old. It's been pervasive. And after 10 days, we're all ready to close the book on it. I think we need to see more. At a minimum, I would say, what's the plot twist in front of us? I think the playbook of rates have peaked, therefore buy risk everywhere. It seems a little too October 2022, not October, November 2023. And, is the plot twist, A, we haven't seen the top in yields, or is the plot twist we have, and it's not as bullish for risk as many people think? That, I think, is the big question as we look ahead.
Before we get there, we need to break into that and drill down on that. Okay, you said I need to see more. Do you need to see more in price or more in the data? What do you need to see more of?
I want to see price's interpretation of the data. I mean, we're sitting here, 10s are still above the 50-day moving average at, call it 450 and change. The 200-day is still upward sloping. The trends for 10-year and 30-year yields everywhere around the world are still up. You could convince me the short end is probably topping in yield here. If you look at some of the 2-year yields across Europe, I can get there. I just think it's way premature to make this call with longer dated bond yields yet.
To build, though, on what John was talking about, last week was set up with a pretty perilous type of technical behind it, where the short positions by hedge funds on U.S. government debt at the highest levels going back to 2006. Have we washed out some of that unevenness, or can we expect bouncing around by 50 basis points every couple weeks in Treasury yields?
It's funny. I think there's this tension in the positioning data. A lot of the stuff we look at from, say, CFTC would suggest there's big shorts still in the long end of the curve that might need to cover here. But when you kind of reconcile that with some of the anecdotal information out there, I mean, look at the last 2 weeks. Cover of Barron's, buy bonds. Wall Street Journal, buy bonds. FT, buy bonds. There's this tension here for a bear market that's 3 years old in bonds. You would expect there to be more fear out there. And that just seems so inconsistent with how things bottom.
When we talk about the data and the response to data, is it the data of economic slowing, or is it the data of how much debt the U.S. Treasury is going to sell? Is that more important for the longer end of the U.S. Treasury curve?
Well, I think that's the secular tension. It's why we have the steepener. I like the steepener, right? So there's a couple ways we get the steepener. Either 10-year yields or 30-year yields continue to rise and 2s fall, or 2s stay stable, or 2s fall faster than the long end. So I think the steepener is still in play. If you look at a chart of the unemployment rate versus the steepener, it's the same exact chart. I mean, we just went 3.5 to 3.9 on the unemployment rate in a couple months here. So I think there's a case to be made. The steeper curve here is playing very much as it tends to do late in a cycle. You tend to get economic deterioration, you tend to get a steeper curve, you tend to get a rotation in the equity market away from the pro-cyclical corners to the more defensive. What was one of the standouts last week? Utilities. Right, so there's a little shift underway here that I think we want to be mindful of.
Well, to your point, end of cycle dynamics, not typically the kind of dynamics you want to buy the broader equity market on. Yeah. What we saw last week was a major rally in the bank sector, not just the index. The banks on KBW, Lisa brought up the chart, up 11%, best week of the year. Yeah. We all understand why. It's the relationship between bonds this year and banks. It's not typically the relationship we typically see. From your perspective, in your opinion, if we get a bond market reversal and it continues, is it bullish risk?
I think when you look at last week, we saw something on Thursday and Friday we haven't seen all summer and all fall. We actually got very good internals. We were 8-1 on the upside on Thursday. We were about 5-1 on the upside on Friday. So I have to give that the credit it's earned. As far as the financials here, I think you point out exactly right. We've had this odd dynamic between rates up and financials down for much of the year. That seems to have reversed a little bit last week. I think the big question is if 10s have certainly topped, and if they're going lower, is that as bullish for these groups as we think? Or are we all going to figure out, wait a second, why are bond yields falling? Bond yields are falling because there's a real problem out there. I lean more towards that camp, but I'm going to let the price action dictate that over time for me.
When does that start to change in your mind? How do you think about that process?
Look at Europe here first. The rallies in Europe last week were not as compelling or convincing. I look at DAX or CAC or the Swedenomics. They were softer and more tepid. I think that's going to be a big tell here. Go back a year ago, it was kind of Europe first to turn up and really express that pro-cyclical message. This summer, it was first to turn down and get pretty defensive. So I think watching Europe here is going to offer some clues about really just geographically how broad this move is.
When you talk about softness, one of the reasons why people justified this idea that you could get a rally in risk even with a yield decline last week was because we're going back to the soft landing camp. What's the sort of threshold where it's not soft landing and it's something just bad?
One of the things we've looked at historically, now, in fairness, the sample size of soft landing is small. 1994, 1984, 1967. We don't have a lot of history of soft landings. Maybe that's the signal, that you've only had 3 of them. But what do all those 3 periods have in common? Consumer discretionary rallied hard coming out of the soft landing. So I think if you're looking for a leadership clue that would suggest, hey, this is Goldilocks, this is soft landing, I think discretionary has to be part of that. I think it's really premature to say discretionary has been resoundingly strong here. We've had a couple good days in discretionary after a dreadful last 6 months. So it's going to be a very important tell for us, I think, over the next number of weeks.
Some people have really kind of tried to wrap their head around what the implication is of what's going on in the Middle East, the potential volatility in oil prices, what we might get down the line that some people have said has kind of been hanging over the market. Based on what you've seen, has that conflict had the potential to be inflationary for a prolonged period of time? Or is it still just sort of not calculating into any of your baseline types of parameters? I
think the latter for now, although I think the history of conflict would suggest they're inflationary, not deflationary. So I want to be mindful of that. And then I would just ask the group here, what's the only asset class in the world about to make a new all-time high right now? It's gold. Right? So what is the message here from gold? We've seen this war premium come out of crude oil over the last 2 weeks, and gold retained its bid. So I think there's something there we ought to be very mindful of.
Well, let's finish on what you like.
Like gold.
What do you like?
I think gold here makes a new decisive high in 2024. I think it takes a starring role on in this movie. 2,500 is our target on gold. When I look at some of the leadership within the equity market, I actually still like industrials here. I know that sounds counterintuitive to a slowdown call, but the track record of industrials in expansion to slowdown is actually pretty random. They can work even as an economy is slowing. I actually like home builders here as well. And I wouldn't get too bearish on energy. I know crude has not acted great here the last couple of weeks. The energy stocks, particularly, say, the gas-related names, actually trade okay.
Can we just finish on gold?
Yeah.
Why is it starting to work? What's happening? What's in its favor?
I've learned one thing in my career. By the time you figure out why gold is working, it's typically too late.
It.
So I enjoy the ambiguity. Maybe it's the Fed's done. Maybe it's dollar's peaking. Maybe there's an accident out there.
But for you, the message is in the price and you don't really care?
I think the message... Gun to my head, I think gold is attempting to tell us that all of these currencies are pretty bad. And dollar in particular. I mean, look at the reversal on dollar yen last week. I mean, talk about a 3 big finger move in dollar yen last week from 52 right back to 49. So I think there's something going on here with USD. I think gold is the best way to express that.
Dollar yen right now, 149.63. Chris, this was fun. Thank you,
always,
sir.
Thank
Good
you.
to see you, buddy, as always. Chris Ferrone there, a strategist with some big calls, particularly on gold. Bramo, gold's starting to work.
And it's because all the currencies are pretty bad, which raises this question, are we going to go back to the gold bugs that are hiding gold bars under their beds as a hedge against people moving away from a debased currency because of inflation and higher debt levels? I don't know. I mean, this feels like back to the 1970s, right?
Only we could end up with something so gloomy after a week so good in the equity market.
Welcome to Bloomberg Surveillance.
In the next hour, Sarah Hunt of Alpine Sachs & Woods on the equity market, constructive on energy, in the same way Chris is. We'll talk about that a little bit later. Your equity market this morning to kick things off this Monday. Equities positive by 0.2%, following the best week of gains for the year so far. From New York City, good morning.
threats coming from militia that are aligned with Iran are totally unacceptable, and we will take every necessary step to protect our people. We're not looking for conflict with Iran. We've made that very clear. We're working very hard to make sure that the conflict in Gaza does not escalate, does not spread to other places, whether it's here, whether it's elsewhere in the region.
Another weekend of intense diplomacy. U.S. Secretary of State Antony Blinken speaking to the press during an unannounced trip to Iraq over the weekend. Blinken continuing talks with officials in Turkey through this morning. Let's touch on the price action for you. If you are just joining us, your equity market is still elevated by 0.2% on the S&P 500 following a massive week of gains of close to 6% on the S&P. In the bond market, yields aggressively lower through last week on a 10-year, back down to about 459.53. 2 weeks ago, through 5%. This is a 40 basis point plus turnaround from the highs of a couple of weeks ago. Plenty of notes out there. This from Savita Subramaniam over at Bank of America. Brahma, you might like this one. The S&P 500 had seen a 10% pullback from the July peak. Not atypical given that corrections happen one time per year on average. Despite today's better entry point for equities, the frequency of clients asking, should I wait for a better entry point, has increased. Gives you the feeling that over the last week or so, it's like Blinken, you missed it, maybe?
That's exactly what I was going to say, is that you get this sense that maybe the rally has legs just simply because so many people were waiting for the time to buy. That said, the idea that cash still provides such an alternative, as Warren Buffett showed over the weekend, that basically is having record amounts of cash that actually are earning something, I wonder how much that keeps people hanging out and waiting for a better entry point. But so far, based on the rhetoric that I've been hearing, out of all of the notes, it was saying, yeah, this kind of feels like it's got some staying power.
The financial markets are so peculiar, aren't they?
Yeah.
You pick up the phone to a client, you try and sell a bond with a yield of 5%. They're like, they're going to go higher. Then they drop back down to 450. They're like, yeah, can I have some? It's so weird.
It's
so
FOMO.
weird.
It's just sort of collective FOMO.
Isn't it odd?
It's yes, of course.
I find it so strange.
Crowds.
Let's get beyond the price action and talk about the intense diplomacy we witnessed once again over the weekend. Joining us now is Julie Norman, the co-director of the UCL Centre on US Politics. Julie, always wonderful to catch up with you. You've articulated this, the pressure to articulate an endgame, given what's developed over the last couple of weeks. Do you sense that pressure is ramping up once again over the weekend?
Well, I think it is, John, and very much from the U.S. increasingly on Israel, mostly behind closed doors, but starting a little bit more publicly as well. And this has really been an issue since after October 7th, to try and figure out what would be next for Gaza after an Israeli operation. There are many different options that are considered, but really none of them seem to be very good for either Israelis or for Palestinians. Israelis and Palestinians are not looking for a reoccupation of Gaza. Some have floated the idea of the Palestinian Authority, the West Bank governance, having a role in Gaza, but they are very weak, very illegitimate, and also, I think, would not take on that role just yet. And the U.S. is even exploring some options of saying having a multinational transition kind of a group there, some kind of almost like a peacekeeping force. But again, all of these are very tentative options. And I think crucially right now is trying to identify what Gaza might look like after this in a way that is, not just a continued downward spiral for both Gazans and Israelis.
Julie, as we can all see at the moment, the administration domestically facing pressure from all corners. Julie, from your position, can you identify any kind of success this administration is having, convincing the Israelis of having some kind of humanitarian pause, convincing Israel of changing its approach somehow? Is there any kind of success you can identify?
Yeah, John. So I would say, the U.S. came out very strong in support of Israel. And some in Israel have called this a sort of bear hug, a public embrace, but also a private restraint and kind of some whispers in the ear. So this has started from the beginning. And I think most importantly, Blinken was pushing for a humanitarian pause over the weekend. That does not look forthcoming at the moment. Some areas where they have had some success is starting to get a bit more aid into Gaza. There are currently about 100 trucks now coming into the Gaza Strip per day. Before the invasion, that was about 500 trucks a day, so still much less than is needed, but more than was coming in for several weeks. The other area that they had some temporary success was getting communications reinstated in Gaza, but I understand over the weekend there have been more blackouts, so that seems a bit inconsistent. So I think that pressure for humanitarian pauses will continue. For Israel, I think they see that as perhaps halting the offensive, and they're halting their overall aim of ousting Hamas. But for others, that is just seen as absolutely necessary for both getting aid into the Strip and getting people out. So I think Blinken will keep focusing on that. And I would note Netanyahu suggested that if hostages were released, that might open up some room for a humanitarian pause. So I think we'll see more focus there in the coming days.
Julie, what I found more interesting, rather than Tony Blinken going to Israel, was all of the other meetings he's had on this particular tour. Right now, he's in Ankara in Turkey. There's a question over Bill Burns and his relationship with Jordan, the head of CIA, and his tour in the region. What is our sense right now of some of the regional countries and their position, their involvement, both in what's happening now, negotiating with Hamas, but also some solution after this conflict is over?
Sure. So I think there's a couple different facets to this. One is, again, the short term, trying to get other Arab states to also back this idea of humanitarian pause. Most leaders are very forthright about calling for a full ceasefire. So Blinken was trying to get some space there, as well as just keeping diplomatic channels open. The second was really in terms of trying to keep the conflict contained and trying to avoid flare-ups in other Arab countries and in other areas, especially like Iraq, where U.S. Troops are stationed and where there are Iranian proxy groups operating. So trying to kind of quell any potential flare-ups and just further dispersal of this conflict. And the third, as you mentioned, Lisa, is again trying to look ahead to what that end game might be and what the role of Arab states might be within that. Again, would Arab states be part of some kind of multinational, transitional authority or force or something like that? Again, right now, I think most Arab leaders are reading the room pretty clearly with their own populations who are very sympathetic to the Palestinian cause and are not going to stick out their neck too far for really what the U.S. is pushing for. But at the same time, work quite closely with the U.S. and some of these states with Israel as well. And so needing to kind of find that middle ground. So a lot of diplomacy happening that I think will be just continuing wholeheartedly over these next couple of days.
Has President Biden lost the room with his own party at this point, given his approach on this conflict?
I would say it's very clear that the Democrats have a lot of internal divisions over this conflict. And this isn't new to Biden. And I think he knew with an issue as difficult as Israel-Palestine, you are probably never going to please everyone, especially in a party like the Democrats, which are pretty split on this issue now. He's getting a lot of very vocal criticism from many on the left, from many progressives, and from many on the pro-Palestine side. But I think he's also getting a lot of support from more traditional liberal Democrats who appreciate the solidarity that he's shown towards Israel. So in some ways, again, it's you're not going to please everyone. And again, right now, the U.S. is trying to find a very difficult middle road and kind of thread this needle between supporting Israel, but also trying to minimize casualties and think ahead to what might be next and what might be best for the region.
It's going to be incredibly difficult for the president going into next year, Julie. Just to finish on that poll from the New York Times over the weekend, big leads for the former president Donald Trump in Arizona, Georgia, Michigan, Nevada, a lead in Pennsylvania as well. Julie, your thoughts on that as it came out over the weekend?
Yeah, this is going to be a big wake-up call for Democrats and for the Biden campaign. We've been seeing these neck-and-neck numbers for Biden and Trump for quite a while, but to really drill down to the 6 swing states and see that 5 out of the 6 Trump is leading with less than a year until the elections is quite notable. And again, this is a little bit different than past elections because both of these men are known quantities. Everyone, and someone like Trump, everything is out there already. So I don't see a lot of this necessarily changing. Obviously, polls are a year out. But I think for Democrats who thought, Trump was going to be an easy target or something like that, it's clear that Biden has a lot of work to do. And that's, it's going to be challenging for him to keep his coalition together. So I think we'll see some different strategies emerging pretty soon.
Hey, Julie, thank you. Julie Norman there of the US South Centre on US politics. Thank you. Where you find comfort is always the risk, right? You can sit here and say it's 12 months out and do nothing about it. And you end up in the same place in 12 months' time.
There is a very real question about whether these 2 individuals are going to be on the ticket come next November. There is a real aversion in the population for us getting a repeat of what we saw 4 years ago. And yet that is where we're headed. And that is the most likely tie-up. So there really raises this question. For one, is this a wake-up call for President Biden? And does he get the message that it's him losing?
Sure.
It's not Trump winning. And number 2, who would that be? And can we consolidate or see some consolidation around some of the other Republican candidates?
12 months of this still to come. Another year. Is that why TK's taking a day off?
I think that, Bloomberg or whatever, people are calling us now.
I got the same message as well. TK's back in a couple of days.
Don't worry.
Looking forward to getting Tom's view on all of this. I think you know it already. Jeff Yu of BNY Mellon is going to join us on the FX market in just a moment. Live from New York City. This is Bloomberg. 5-day winning streak on the S&P 500. Can this become day 6? So far, longest daily winning streak going back to July, I believe, June to be precise. Equity futures on the S&P 500 positive here by 0.16%. On the Nasdaq, we're positive by 0.2%. The scores last week, the Nasdaq up by 6.5%. The S&P 500 up by 5.85%. Bramo, we talked about the banks briefly. If you are just joining us, the banks last week, KBW Bank Index up 11%. Best week of the year.
And you've been pointing this out. The irony here, we were talking about how higher yields are better for banks. Yields drop, ostensibly on weakness in the economy, and banks rally. So try to make sense of this from a fundamental perspective. I think there was a breath of relief, especially allowing people to see earnings, which have been better than expected pretty much across the board.
What was it in the bond market? And let's check out the bond market together. 2-year, 10-year, 30-year, and just sit on a 10-year portion of that curve. 459.53. So 2 weeks ago today, we had cycle highs of 5.02%. I'll round that up. Was it the data? Was it the Federal Reserve? Was it the Treasury refunding non-announcement? What was it?
It was a recipe.
All of the above.
Yeah. Well, it was like, sort of this slow progression. First came the refunding announcement, and that really turbocharged the rally on the long end. And then you saw the Fed announcement, and that turbocharged the rally on the front end. And then you saw economic data that sort of leaned into this idea that we are seeing the slowdown that the Fed wants. And that just turbocharged all of it together. How much is this positioning, and how much is this? Just fundamentally, that people are realizing that maybe they got a little over their skis.
On a 10-year, 40 basis point move off the highs in just, 10 days?
It was
a couple
crazy.
of weeks. Kind of nuts, to be honest with you. Let's finish on foreign exchange. The euro had a fantastic week, largely because the dollar had a terrible one. The euro coming off the best week of gains since July on that currency pair, 107.46. We're positive again this morning by 0.1%. Under surveillance this morning, Israeli troops encircling Gaza City, effectively cutting off the north of the Gaza Strip from the south. Israel's military saying its ground forces took control of a Hamas base in the area, while its air forces attacked around 450 Hamas targets in recent days. The Washington Post reporting the Biden administration is growing frustrated, Lisa, by the number of civilian casualties from Israel's campaign against Hamas.
So there are a number of questions sort of embedded in this. Number one, how much influence does Washington have over Israel at this point, especially given the fact that Netanyahu is not exactly the most popular politician and most Israelis want him out. But then there's also this question of, is President Biden losing the room with his own party? And we keep talking about that. How does he try to massage their role in a conflict that has polarized society across the world? And I don't know the answer to this.
It's certainly an extreme wing of his party. Did you see the protests in Washington over the weekend?
I did. I have to just be honest. Part of my difficulty with this is that nuance is lost in this discussion. It's very difficult to have any kind of nuanced discussion. It's very difficult to have the view that it is horrific to see children and families being killed in Gaza or starving or suffering with dehydration, at the same time that it was a horrific massacre in Israel that cannot happen again. It is very difficult to have that conversation, even though that's just human.
We'll try and have that conversation through this morning. I think, as often the case, Lisa, criticism of Israel is conflated with anti-Semitism. It's very difficult not to conflate the two, though, when you see a protest taking place in the nation's capital with certain flags being waved and certain slogans being held up, and seeing those slogans defended by people who are sitting in Congress. That makes it very difficult.
Rashida Tlaib of Michigan coming out and saying that from river to the sea, Palestine will be free, was a chant of freedom. And even her own Michigan Democratic colleague calling her out and saying, no, that is not what it has meant historically. Please retract it. All of these things are such a difficult moment because, yes, it is difficult to have nuance, but some of the imagery has been clearly associated with historical tropes that are anti-Semitic.
Without a doubt, and it makes it very difficult for the president to try and navigate these issues. 1 year out from the 2024 election, President Biden trailing Donald Trump in 5 of the 6 key battleground states, according to a New York Times poll showing Biden down big in Arizona, Georgia, Michigan, Nevada, and Pennsylvania, while holding a narrow 2 percentage point lead in Wisconsin. Biden won all 6 of those states in the 2020 election. At least a big wake-up call for his party, for his leadership over the weekend.
So who takes his place?
Big question.
And the fact that Kamala Harris was actually doing better than him in these polls.
Which is kind of shocking, given her favorability rating that we've seen over the years.
It is completely shocking, which raises this question, will President Biden simply say, well, just wait, we have 12 months, it's not a big deal, or will there be a very deliberate effort to try to come up with who might replace him on the ballot next year. We don't know exactly what this ballot's going to look like.
We did a poll with Morning Consult in the last couple of weeks. I know you guys talked about it around this table. I think it's worth repeating. 3 in 4 swing state voters said the country's economy is headed down the wrong track. And they're more likely than not to say their personal financial situation was better off under Trump than it is under Biden. Now, is that better off pre-pandemic versus post-pandemic, or is it better off under previous leadership, under current leadership?
Honestly, I was reading this too, and I was thinking to myself, okay, on one hand, you've got different economic cycles, and the person in charge is going to get blamed for it, whether they're responsible for it or not. The bottom line is it going to be economics that drives the election cycle? Is it going to be what we're seeing internationally with geopolitics? Is it going to be something else, the sort of social issues? We don't even know that, let alone the cast of characters that we're going to be dealing with at that point.
Janet Yellen's under pressure.
Yes, she is.
Taking some real stick at the moment over the way she's conducted affairs over Treasury issuance and all that kind of stuff.
Well, is it really tied to the financing needs and having some predictable sense, or are they trying to time the market and basically cater to the fact that they don't want to really disrupt anything on the long end?
I bring up Janet Yellen because she's also going to have an important meeting with her Chinese counterpart later this week over in San Francisco. This really setting the stage for the bigger meeting we're all expecting between President Biden and Xi Jinping at the APEC summit later this month. Is there any incentive whatsoever for this current president to play happy summit time with the Chinese leader going into next year?
No, there's not, except for one thing.
What is it?
Just getting some sort of de-escalation over in China so that at least people aren't worried about that geopolitically, that maybe that allows people to focus more on other things. That said, it'll open him up to criticism, as you point out, rightly so, during the election cycle. Hey, you're buddy-buddy with Xi Jinping, really?
Yeah.
And that's not going to fly, and it hasn't politically.
They're spinning place at the moment. Big time in this administration. Really difficult stuff. If you are just joining us, equities are positive by 0.2%. We had a massive reversal in the bond market over the last couple of weeks, through 5%, back down to the 450s on a 10-year. Let's get to Jeff Hughes, Senior Market Strategist at BNY Mellon. Jeff joins us now. Jeff, were those highs the highs of the cycle?
We can easily revisit those highs and higher up again. We tend to think of this as a symmetric process. You know, things ramped up very quickly, yields ramped up very quickly, and they can come down just as quickly. Well, let's go to the Bank of England's monetary policy report. You know, their third judgment clearly said this is going to be asymmetric. The process down is going to be slow. Let's look at the RBA tomorrow. After 6 months of pauses, they're going to start hiking again. Looks like a new economic cycle has ticked up there. If you look at how the real estate market is doing, and actually, if you look at the UK, US, Australia, you could argue these are very different cycles, but all dealing with the same issue. You know, demand isn't going away anytime soon.
So, Jeff, what do you think is going to stick around that ultimately leads to a retest of the yields we saw over the last couple of weeks, given developments we saw last week from the Federal Reserve and in the economic data as well?
Well, services inflation globally is going to remain high. I think that's the bottom line. If that's what the ECB is even worried about, arguably the major economy with the softest in services impulse in terms of growth. I think the market is falling into this sort of trap saying, OK, unemployment rate's going to tick up to, 4.5%, 5% or anything like that, and really start to drag down wages. We saw during the post-pandemic reopening, you know, what companies will run into when you actually lay off a lot of workers and there's a labour supply shortage. There's going to be a lot of labour hoarding up ahead, which means the unemployment rate is not going to go up aggressively, and also the labour market is going to remain relatively robust. So in that sense, I don't think services growth, price growth is going to go away anytime soon. It's far too early to be talking about easing, so just beware of that sting in the tail.
If Treasury yields have not seen their peak, if they are going to go higher, does that mean that the economy is strong enough to also support risk appetite?
Well, it really depends where you're looking at. But I think with the US, you know, right now, we're talking about US exceptionalism. I think for the time being, the US economy is strong enough to sustain the status quo, right? So, of course, we're going to look at earnings. And I think the way, if I look at our flow data, what our investors are doing right now, they are going into equity market risk, but in the most conservative way possible. We're seeing them buy consumer staples, seeing them buy utilities, and you're getting some kind of defensive protection there. But from an asset allocation basis, you know, there is cash on the sidelines waiting to go into equities as well. But that's just a positioning view. So again, from a sectoral allocation point of view, still very, very cautious out there.
What do you make of the idea that gold just keeps rallying? And we were talking earlier this morning with Chris Ferrone. He likes gold, and he thinks that it's going to be an alternative as people kind of shy away from all currencies that are getting debased on some level from both inflation as well as incurring a greater amount of debt. Do you buy that argument?
I fundamentally disagree with that. So, gold at the end of the day, it should have been much more susceptible to global real yields. It's not right now suggesting there is a marginal buyer in place. But is it, from a liquidity point of view, a credible medium of exchange? Does it store value in times when clients are chasing yield? And, for example, there are many boxes it does not tick. Short alternatives away from the dollar, alternatives from treasuries. I think that is a message, or that's a conversation investors, asset allocators will have ad infinitum. But I don't think gold should comprise a significant part of that conversation.
Ultimately, Jeff, the point that Chris was making that was that within foreign exchange right now, there's nothing else to like. That every currency's got a bad story to tell. Jeff, can you identify one that's got a good story to tell?
Well, so ultimately, currencies, it's always relative right now. So I'm quite favourable on Aussie right now. We have seen the Australian Prime Minister trying to exert some pragmatism in its relationship with China. By all accounts, this trip to Beijing and Shanghai has gone relatively well. I look at Aussie against CAD, Aussie against Euro even. I think now that it does offer liquidity as well. Potential safe haven now. Then, as amazing this may sound, I think in a European context, sterling may actually do slightly better up ahead against the Euro, due to growth potentials, less stagflationary. I think Swiss franc, could be on one of those runs. Again, watching the SMB's activities and closely, there are alternatives out there to move away from the dollar, and also EM. No one owns EM currencies too aggressively at this point. Look at Brazil, look at MEX, offering good real yields. There are alternatives out there. I think just asset allocators are not willing to take the plunge yet.
Embedded in what you just said is this idea that if we are going to be at a holding pattern, at least for central banks for a little bit, that it's going to go back to growth differentials most of all. Is that sort of what you're saying, that we're going to move away from this fuzzy, is it going to be the Fed, is it going to be the Bank of England, is it going to be the ECB, back to what actually is going on the ground with growth that'll determine the valuations?
Yes, I do agree with that. So growth on the ground at a corporate level, at a household level, and the household leverage is not high, compared to 2007, 2008 levels, I think. And also servicing ratios are much more manageable. I think that point is often missed right now, when we talk about the state of the household, but also its growth subject to how you are positioned relative to that growth. And I think this is where select EM and even some minor G10s, they could benefit relative to some of the more major economies.
Jeff, have we seen the UK housing market bottom already?
I think, one interesting fact about the UK housing market is households seem to be deleveraging, right? So
interesting.
In terms of transactions, there is a source of bottoming out. But we've had 4 months of negative contractions, of negative lending secured on dwellings in 6 months, right? You barely get that over the course of a decade. Even during the 1990s, that housing correction, that didn't happen. So I think people are not taking out larger mortgages when they're remortgaging or they're paying back to reduce their household service ratios. And that, with income growth, allows them to keep on spending money. So I think this is why, again, services inflation globally is still relatively firm.
Jeff, thank you, buddy, as always. Jeff, you there of BNY Mellon.
Pleasure as always.
Out of London this morning. Appreciate it, as always. Lisa, it's difficult to believe that we've fully realised the pain associated with certain housing markets around Europe and I would say into the United States to some extent as well.
You mean you can't really have any conviction around a broken market?
With rates where they are right now, given how frozen things are in places like America, it's difficult to make that call.
What would have to happen would be for benchmark borrowing costs in the mortgage market to drop by 300 basis points to start getting a real flood of any sort of activity in this. That seems unlikely in the near term unless there's something really significant that happens. So to this question, are we seeing any kind of restrictive effect based on a housing market that just is stagnant, that just isn't moving? Basically, people are just saying, oh, we'll just buy new homes and just deal with that problem once rates comes down. What if they don't? And that's sort of what I was speaking to. Higher for longer might be more punitive than anyone can really imagine.
Forced selling. Things would have to get so bad that you had to leave that job or you were pushed out of it, that you had to move state, you had to sell that house. Until you get there, why on earth would you sell it if you're sitting there with 2-3% mortgage rates for the next several decades?
Which is the reason why people are looking to the employment rate, because that essentially will be the catalyst for some motion in possibly a negative way.
Equities right now, positive 0.2%. Coming up shortly, Will Kennedy on the oil market from New York City. Your crude market right now, 81.79 on WTI. This is Bloomberg.
There are no direct risks to supplies. And that's probably what's made it very hard for oil to rally. The European and US demand numbers definitely are weaker. So I think all of that together just means that, crude's probably going to remain range bound for now. Not much of geopolitical premium in the price.
And Rita Sen there of Energy Aspects. Only a month or so ago, we were talking about triple-digit crude by Halloween. Do you remember that conversation?
We asked her about it and we said, okay,
what did she say?
It's 2 days until Halloween. We're not probably going to get there. And she said the reason why is interesting. It's because of a lack of demand. It's not because of potential supply shocks that people see being percolated from this conflict.
We got to 95.
Basically, it's the same
It's just
thing.
short. I have to say, surprise for me, for most people, I think, the month of October. Let's take a look at crude right now. Brent's at about 86. WTI in the low 80s, just short of 82. The month of October down almost 11%. So you've got a terrorist attack on Israel at the start of the month, basically, the first week. All these calls potentially for higher crude prices because of the risk that we're going to see this conflict broaden out, perhaps. And crude goes the other direction, and aggressively so.
It doesn't make sense from a geopolitics standpoint. It does make sense in tandem with some of the decelerating economic data points. And that might be what people are hooking into, the fact that people might be traveling less and that a lot of industries are maybe not generating as much, particularly with the manufacturing recession that we've seen in the U.S.
Crude up this morning, WTI 81.76 up by 1.5%, Brent crude 86 up by 1.4%. Will Kennedy with us now, Bloomberg Senior Executive Editor for Energy and Commodities. Well, can we start with October before we get our teeth into November? What did you and the team make of that move through October? What was that about?
I think you and Lisa hit the nail on the head, basically, is that two things happened. One, after the events in the Middle East at the beginning of the month, people were worried about a wider conflict. I think a lot of those fears have dissipated, that the situation is, of course, horrendous, but the fears that it might spread into a wider conflagration for now are down a bit. And second, as Lisa said, I think there's an increasing concern about the state of the global economy going into 2024 and what that might mean for projections for oil and demand growth not being as strong as traders had predicted a few weeks or a couple of months back.
How much, Will, do you get the sense that volatility is going to be really high in oil over the next few weeks? There was a study in the Wall Street Journal over the weekend talking about how always after geopolitical shocks, there is this incredible volatility that maybe people are a little sanguine about given the decline that we were talking about last month.
Yes, I think that's exactly right. That, when you do get these kind of events, they are, by their nature, they surprise more. They're less open to analysis. They're more open to interpretation. I think that can lead to swings in the market. In that context, it's interesting that the Saudis are trying to steer a steady course. They announced that they would keep their voluntary 1 million barrel a day cut into December, which I think tells you that they share those concerns about demand and that they're going to adopt this precautionary principle, which is to try and keep prices stable and steady, at least where they are.
This is kind of a delicate question, Will, but do you get the sense that a lot of Western politicians are turning a blind eye to a whole host of things in order to keep oil prices going down rather than surging up? And I think, for example, about Russia and how there are a number of reports about how revenues from oil have just been absolutely skyrocketing because sanctions are not working, but no one really wants to crack down too hard because that oil is offsetting some of the potential supply disruptions that people are worried about.
I think in the case of Russia, it is partly a blind eye. Clearly, they could seek to enforce the price cap more strongly. But the other thing that's happened is that Russia and its customers have built a very sophisticated and resilient supply chain to get that oil from Russia to India and China in a way that doesn't even come against sanctions, in a way that sidesteps sanctions. And that supply chain has really bedded down, firmed, become more secure. And that's why you're seeing this flow of oil at prices way above the price cap. I think there are other parts of the world where the blind eye question is pertinent. Iran is obviously one. There was some talk after events in Israel at the beginning of October that the US might face pressure to clamp down on Iranian exports. That hasn't happened for whatever reason. And clearly they also moved to increase the flow out of Venezuela, suggesting that, yes, oil sanctions are not flavor of the month in Washington.
Well, can we just finish where we started, which is on demand? You can learn something from how much Aramco sells crude for to different parts of the world. Are you getting a different picture, just Asia versus Europe versus everywhere else?
That's really interesting, John, and I think a really important point. Those official selling prices, which they set every month and benchmark against global benchmark prices as a premium or a discount, we got those early this morning. They raised prices for Asia, suggesting that they're still finding it relatively easy to place their barrels in Asia with customers who want those barrels despite the flow of Russian crude that we've discussed. But in Europe, they slashed them. Now, Saudi Arabia doesn't currently sell a huge amount of oil to Europe. Most of it does head east. But the fact that they're doing that, I think, shows that they're more worried about demand in Europe than Asia right now, which is an interesting insight.
Are you hearing that from any of the energy players as well, Will, as we start to get earnings?
I think, yes. I think one of the themes that we saw in energy across the oil major earnings is that they are worried that refining margins are going to be very weak coming into the end of the year and early next year. And I think that reflects, and we wrote a story about this over the weekend, that in Europe in particular, demand for diesel and naphtha, a type of oil that's used in chemicals, is weak and suggests that the industrial economy in Europe is really not in very good shape at all.
How much is this really tied to a shift in the type of energy that people are using? Not just electric vehicles, but increasingly natural gas around the world.
I think the bigger problem, especially in Europe, is that Europe's industrial base remains quite hit by higher energy costs. Hasn't really recovered from the hit that it took in the energy crisis that followed Russia's invasion of Ukraine, and a lot of that demand from factories and the associated demand from trucking, a lot of that chemicals demand still remains very weak and hasn't really recovered. And I think the question in Europe is how much of a permanent hit there was to some of this demand.
Hey, Will, wonderful to catch up with you as always. Send our best to the team. Will Kennedy there of Bloomberg, leading what obviously we believe is to be the best commodity research and news team on the planet, but ultimately it is. Aramco, selling prices Europe, down, getting slashed. Will's words. What's happening in Europe right now? Is that economy really starting to crack?
I think a lot of the data shows that yes. I mean, you're seeing that month over month. And earlier today, we got data out of Germany that did cohere with some of the weakness that people had been expecting. But in France, it was weaker than expected. Some of the data in terms of the economic generation, particularly for manufacturing, it hasn't been good. So then how long is that going to be a divergence to the negative while the U.S. holds up at the same time that there's also a manufacturing and the recession in the U.S.?
And we're all talking about central banks moving in the same direction at the same time, synchronized all at once, the Federal Reserve, the ECB, the Bank of England. It's the ECB. Walk us through the approach we got from President Lagarde compared to Chairman Powell. How much daylight was there? And then compare what we're learning on the European economy versus the US and how much daylight is there. Does it make sense that one has the same approach as the other?
They're both buying time. The only approach that I can see right now is they're both buying time until there is a conclusive trend that requires a response. That is the only relevance right now between the U.S. economy that's showing a lot of strength, albeit weakening at a certain clip, versus Europe that's in downright recession and not seeing a lot of potential optimism to really revive. So at this point, they both just want time. The question is it really going to be the same kind of outcome that they're going to be facing in 2-3 months?
Well, this equity market loves a more patient central bank. Let's go through the scores. Your equity market positive by 0.2% on the S&P 500. Last week up by 5.85% on the S&P. On the Nasdaq, positive by 6.5%. We mentioned the KBW bank index a few times already this hour. I think it's worth doing it again. To see the bank index up 11%. The best week since November 2020. Given what you're told continuously that really what banks want is a decent economy and higher rates, then banks get there and they have a terrible year until they start to get weaker data and maybe the prospect of lower rates, and we absolutely rip off the bottom.
Which raises this question, how much conviction is there behind any of this trades? Remember when we were actually talking about SLOOS and people were using that as sort of this common acronym that now people have all forgotten, right? Everybody was saying, oh, wait, just wait for those. That will tell you just how much we're about to crack and everything's going to go away. And now we're on the brink of getting that, and people are like, it's going to be fine. And if it really comes in deteriorating, but yields are going down, so maybe you can. It's so head spinning to try to get your head around this with some logic.
Chairman Powell is going to speak again this week. Are we getting anything from him at all? Is that just sort of him opening up some kind of conference, or is it a real direct speech on something?
It's a direct speech, but are we really going to get anything? What can he say?
He has the option to say nothing if he wants. It's one of them.
But what is he going to say?
You know, you get that second headline that says he has not mentioned anything about monetary policy.
Yeah.
Is that what happens this week?
He's going to have to mention something.
Okay.
But I don't really understand what he will want to say. Doesn't he like that he
Financial conditions are too easy now.
I don't think he's going to say that.
Week to week.
You think that's going to happen? Yeah, I don't think so.
Just got a message on the Bloomberg, just says recency bias.
Yes.
There you go.
The narrative is changing, and the facts are driving that.
There are deviations from the trend. The trend has been moderating.
It's good news that we have a strong labor market.
We are in a pretty good position with respect to productivity.
We expect the market to continue to rally into year end.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market is positive by 0.2% on the S&P. Let's embrace the happy talk. After the biggest week of gains of the year so far on the S&P 500, Brett Ryan, Deutsche Bank, the Fed is done. Max Kettner, HSBC, Goldilocks is back.
Yeah. Is this happy talk really driven by something fundamental or just what you talked about earlier, recency bias, which is basically the new plastics? It's recency bias.
Sounds painful for you, Bramo, but I'm with you. I think a lot of people right now are frustrated with the idea that we're constructing a one-year forecast based on the previous week's price action.
This is such a frustrating moment. Can I just say that honestly, every week we have a new narrative. It's been narrative ping pong that we've been talking about all year. And suddenly people are changing their outlooks on a dime as every swing in price seems to happen. And is it happening on technical reasons? Is it happening on fundamental reasons? It is a nuanced picture with data giving you conflicting signals, and people are taking it and just writing whatever narrative they'd like.
We can have some healthy debate here. Barclays believe the Fed is not done. They're going to go early next year. They think the dovish term may have backfired based on a price action we saw last week. Morgan Stanley's Mike Wilson, still bearish, saying this looks more like a bear market rally rather than the start of a sustained upswing in the equity market. That's the debate we've got to have through this week.
The debate here is, and it really, you highlighted it so well, John, which is basically, are yields going down a good thing? If it really comes with a certain degree of economic pain that has not been priced in. What are we understanding as being priced in at valuations with yields where they are, where they haven't been for more than a decade? These are all questions we can't answer. What are we going back to in terms of base rates? So people are basically just ignoring all the bad stuff, trying to look at the nuts and bolts, coming up with an opinion, and trying to sell it.
I'm still stuck in the previous month trying to work out why they were up. Was it because the data was good? Was it because of supply? Before you get to work out why they're down, have we figured out why they were up in the first place so much over the previous few months?
We literally asked every single person who came on, why are yields going up so much? And pretty much every single one of them said, it's a confluence of events. How much is each one of them? We have no idea. I mean, it's like baking a cake, but not understanding what the different potential measurements are.
You just come up with this one. It sounds good.
Thanks.
We'll run with that. All right, stick with it, Bramo. Equities right now on the S&P, positive by 0.2%. If you are just joining us, here are the scores in the bond market. Yields up by a couple of basis points, 459.32. Last week, they were down more than 26 basis points on a 10-year. On a 2-year, we were down about 16 basis points or so. So, Lisa, the whole curve just shifting lower off the back of the Fed speak, the meeting last week, the data, payrolls on Friday, and the Treasury refunding announcement, which was, let's just say, not as bad as people maybe feared.
If you think this is a readjustment of longer-term benchmark rates and what the neutral rate is, I find that hard to believe. Whether this is people just basically throwing darts at a board and finding out when they can buy, it feels a little bit maybe more concrete. Maybe we'll get a sense this week of how things settle out with the quiet of not a ton of economic data. Monday, today at 2 p.m., I want to know what smaller banks, what regional banks are doing with the lending situation. The Fed releases its SLOOS, the Senior Loan Officer Opinion Survey for the fourth quarter. Does it confirm the slowdown that we've been talking about? And does it lead to a possible continued pop in shares that, yes, rallied 11% this past week, but otherwise have been completely battered? On the political front, we haven't even talked about politics. I mean, how do you come up with a parameter? We don't even know who's going to be running next year. The third Republican primary debate will happen on Wednesday at 8 p.m. in Miami. The crew so far that seems to be at least confirmed as of now includes Ron DeSantis, Vivek Ramaswamy, Nikki Haley, Chris Christie. The field is going to widen. Do we have a sense of who is sort of the front runner among the non-Trump potential nominees.
Who's got momentum? Nikki Haley. You know who the front two on that screen is, Ron DeSantis, Nikki Haley, but one's got momentum, the other one doesn't, Nikki Haley. You said we don't know who's going to run. Yeah, for both parties.
I know.
Not just the one up on the screen. I've got to go back to that poll from the New York Times over the weekend. States like Michigan, Arizona, Georgia, Nevada, big leads for the former president. Nevada, listen to this, 52% to Biden's 41%. You can make the case that's an outlier. There's 12 months to go. There's a risk associated with that by sitting here and saying that's an outlier. There's 12 months to go. You sit on your hands to do nothing and hope it turns, and it doesn't.
My favorite part of that was that a generic Democrat, not named, was actually winning against former President Trump by 8 percentage points. That just gives you a sense of how it's really a referendum in some ways on Biden, at least right now. Meanwhile, Fed Speak does return, just in case you were missing it. Fed Chair Jay Powell will speak on Thursday. So here's the question. Will he be able to say anything? Will he want to say anything? Or is this going to be another kind of, basically we're kind of trying to come up with a consensus between polarized members, so I'm not going to really say anything of too much conviction.
He's said enough, hasn't he?
I don't know.
The impression he's said enough.
Yeah.
I think he said enough. Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, joins us now. Sarah, has he said enough?
Well, I think he's trying really hard not to say anything, so right now that's enough, right?
How did that work out last week?
Well, it worked out to the point where the market looked at everything and said, okay, we're done with everything, and so now we can feel better. I think the biggest tension is, are we going back to the zero rate policy that we had since the great financial crisis, which is part of what I think gets equity markets excited when they think yields are coming down? Or are we going to stick at a place where those rates are a little bit higher? And that's the tension that you were talking about. And this up and down is, I think, looking for levels, and the market is trying to understand what that really means. But I think the relief rally that we got last week in the equity markets was definitely on the back of lower interest rates and the idea that the Fed is done, and next year we're going to start dropping rates.
Do you think it's a mistake to extrapolate out the improving sentiment we witnessed last week through the end of the year?
I think you're going to see some of that sentiment continue on the positive side because there's not a lot that comes in between, right? We had third quarter earnings and it wasn't terrible. It was actually quite good. The commentary wasn't so great, though, going forward. So now we've got this tension between next year earnings are supposed to be up 12%. Companies are telling us that demand is a little bit lower and they don't see the things as good as they have been in the rearview mirror. So that at some point that's going to have to come together. But through the end of the year is, I don't know. I think we could see some positive action through the end of the year.
You said that there's not a lot that happens between now and the end of the year. We do get a potential government shutdown. That's about 12 days away. We do get potential election color. We do have a conflict right now that's going on, two places, two fronts. We've got what's going on in Ukraine and what's going on in Israel in the war with Hamas. How do you put that together and understand this at a time when people are just trying to look at earnings and things that make sense to them?
Well, I mean, this is the sad thing about the fact that the markets aren't always the economy and the markets aren't always what's going on. So they are looking through a lot of this action because they're not seeing that as being effective to them. Even the government shutdown, which was threatened in September, didn't seem to have a huge effect on what was going on. We'll see what happens. If we get a longer one or a protracted one, that could be a problem. I think also the whole issue of Treasury issuance and not going so far out on the curve also didn't dump a whole bunch of supply in there. There's so many things that were happening at the same time, but I really think it's looking for what is the story going to be? Is it pre-financial crisis kind of interest rates, or is it post-financial interest rates? And therefore, they have to come down. And I don't know that that's the case.
One of the convictions that you've had so far this year has been with energy stocks. And I wonder, talking about the conflict that the war between Israel and Hamas, how that factors in, considering that we're likely to get more volatility in oil prices going forward.
Well, there used to be a much bigger spike in oil prices on volatility in the Middle East, and there was some this time, but I think some of that's already come out of this situation. I think that the continuum between the Russian crude getting on the market, but gas still needing to get to Europe, I think there's still a lot of room within the energy space where there will be companies that do well, but I don't think that until and unless you see that get worse, which none of us want to see, I think oil is being fairly quiescent here. And I think part of that is also because there's excess capacity in Saudi, and that helps.
What are the lessons from the massive consolidation we're starting to see between some big players picking up smaller ones?
I think that that's telling you they're all looking at a world where whether or not, my base case that we have a longer tail on hydrocarbons, they're looking at the perception by investors that this industry is going away. And so therefore, instead of going out and spending a whole lot of money doing something like exploring other places, they're just going to they're going to consolidate that industry so that they can withstand whatever is coming at it, and so that they can also start to put some more money into some of the other places that will be growth areas as opposed to just a tail.
Is this better for shareholders?
I guess it depends on what shareholder you are, right? And it depends on whether or not you got bought at a premium. Some of these mergers have not been enormously helpful to the acquirees, but I think that as a longer-term shareholder, if you can get those consolidation of cash flows and they give it back to you, which many of them are still doing in quite hefty dividends, then that can be helpful. But I don't think in the near term that's the best thing for
well, this is really what I'm asking. In the near term, where do I want to be? With the smaller players that might get bought out, or the bigger players that are going to end up being around for a long, long time?
Well, to the extent that there hasn't been a huge premium paid for those smaller players, it hasn't mattered much. Although the acquirers, like if you look at Chevron, that stock got hit on that acquisition. So you don't necessarily want to be in those because people are not looking at them like that's a fantastic ultimate strategy, even though it very well may be. Some of those energy mergers that happened several years ago that people couldn't understand ended up being good for the companies that bought them. But sometimes it takes a long time for that to play out in the energy patch.
How much are you finding yourself trying to justify why energy stocks will continue to do well even after the rally that they've had into a slowing economy?
So that's definitely a timing issue. And I've said before that sometimes you need to have some positions you can trade around, but I don't think you want to get out of energy entirely. If we're really going into a slowdown, and the lack of demand is what's driving oil prices, which is why I think the Saudis are taking oil off the market, then you've got bigger problems than the energy patch, but it's going to be a problem for the energy patch as well, because those earnings that people are looking for are not going to come through if we're really slowing down. But it is going to be, it is more difficult for them to perform in a recessionary environment. But we've also had some real underperformance for several years and some real underinvestment. So there's a lot of different puts and takes there.
Over the past month, it seems like we've had about 6 narratives. Have you shifted anything fundamentally in how you're approaching a moment where maybe we've peaked out in yields, maybe we've seen the economy start to turn, maybe we're starting to see a little bit more of a coalescing around certain levels?
I think that the last month or so, we've been spending a lot of time really trying to think about what's going to happen next year, because what you really want to do is worry about where I'm going to be positioned next year and what we think is going to happen on the macro level and for markets and globally. There's a lot of things that we can't control. There's a lot of exogenous variables. We have no idea how the geopolitics plays out. We don't know what's going to happen with the government shutdown, but we can take a look and say if the economy does this, then this group of stocks is going to do better than that group of stocks, and where do I want to be positioned? And I think that that's where we've spent a lot of time. The zigzagging back and forth in the last week or so, no. I mean, that's, I was not surprised to see a rally. I was surprised to see it that strong. But if the tightening of conditions had done the Fed's job for it, it just undid the Fed's job for it. So where do we stand now?
Which
right?
is the point that Barclays are making this morning. I can sense the frustration from you and pretty much everyone sitting at home right now listening to this. It's almost year-ahead outlook time. Some of them have already been written. I can't wait to see how that consensus comes together, Lisa, for projections for 2024 when we can barely project past next week.
I completely agree. How often are you going to rewrite next year's year-ahead outlook?
Good luck. Never mind March.
I kind of love that. I think that there should be a revision, and just sort of like a check to see how many times
I always say revision
revise.
date is March. That's when you have to revise them. It's going to be a couple of weeks into the year. Like 2 weeks, 4 weeks.
That's what it was last year. It was a couple weeks, then we started to get the revisions in mid-January.
Ridiculous. If you are just joining us, welcome to the program on the S&P 500 right now. We are just about positive. We're up on the S&P by 0.15%. Best read of the weekend for me in the Financial Times. It came from Jason Cummins, the chief US economist over at Brevin Howard. And he wrote this article, bond yields signal the end of the new normal. He's calling it the new abnormal. The new abnormal, an era of higher and more volatile inflation leading to broad changes in the investing landscape. Is that how you're thinking about things?
I can't hear abnormal without thinking of Young Frankenstein, and that's not a good thing to think about for the markets either, is it? I think this is really the tension. It was sort of like we had this whole years of economic data where you had positive interest rates. Then you had the financial crisis. Then you had 15 years of negative interest rates with everybody going, how is that going to, that can't work. How is that going to affect everything? Now we're sort of flipping back, and we flip back rather violently. The fact that you've got a lot of long-term dated debt out there helps that, but that's starting to catch up, and I think that's what you were seeing before this reversal, was people were starting to go, my goodness, if we're going to have to refinance at 6, 8, 9%, what are we going to do if I'm a commercial building or anything else? So,
Apparently we just keep buying credit. just what's been happening. Right,
which also is kind of confusing.
Sarah Hunt, thank you. Just wonderful, as always. Next hour, we'll catch up with Mandy Zhu of SIBO. In about 5 minutes, we'll catch up with AMH down in Washington on the latest poll out over the weekend. Not great reading for the sitting president. From New York, this is Bloomberg.
Work through the weekend on a stopgap measure. We recognize that we may not get all the appropriations bills done by this deadline of November 17th, but we are going to continue in good faith. And the difference between what we call on Capitol Hill a continuing resolution now and what we've dealt with in years past is that this would allow us time, and everybody understands, allow us time to continue this appropriations process. We're committed to bringing 12 bills to the floor.
The work continues. The division persists. That was House Speaker Mike Johnson speaking on Fox News over the weekend. Live from New York, welcome to the program. Your S&P 500 stacking up as follows. Here's the price action. We're positive here by 0.15%. Looking to add some weight to a big, hefty rally last week. Biggest week of gains on the S&P 500 for the year so far. In the bond market, yields bleeding just a little bit higher by a basis point or two. Your 10-year 458.91, way off the highs, Lisa, from 2 weeks ago.
The volatility here is just sort of shocking. And the fact that we don't understand, to your point, why things went up so much in terms of how high yields went up, nor why yields are down so much, gives you a sense of just where we are and how difficult it is to say, well, actually, now we've stabilized around this level. Is there any conviction right now out there from anyone you've spoken to or read from?
There's a hope that it can continue. This came from Standard Chartered. Eric Robertson wrote this over the weekend. If the US rates complex has peaked, then these asset classes are due a significant rally into year-end from short covering, if nothing else. He's talking about US equities, EM assets, and non-dollar currencies.
Don't you get the sense that people are just looking for ideas that within sort of the turmoil to be able to say something, but there's absolutely no conviction? I know, but at a time of such little conviction, they've got to change every week depending on what the parameters are. I mean, that's sort of how it feels right now at a very difficult moment.
If you were navigating stars under cloudy skies and you wanted some visibility, you get it this week with tons of Fed speak. You excited?
Oh, I'm so excited.
Chairman Powell a little bit later.
Really good.
Looking forward to it. Always exciting. Joining us now is AMH down in Washington, D.C., our chief Washington correspondent. AMH, we've got to start with that poll from New York Times, Siena College. There are just big leads in key swing states, and it's not for President Biden.
No, it's for the former president, Donald Trump, although we should note that poll after poll does show that both these individuals, voters don't want to see either of them running or to become president. But when you look at this potential redo of 2020, what you see here is that the former president is leading in swing states. In five of the 6 that the New York Times Siena polled, the former president is leading. And Jonathan, it matches the Bloomberg News Morning Consult recent poll that also shows that Trump is ahead in swing states. And big issues like the economy. Many of these voters say they trust Trump more than Biden. And also on things like national security. And this poll as well takes into the fact that we now have this new conflict between Israel and Hamas in Gaza. And they trust Trump more. So this is obviously going to be another big wake-up call for the Biden administration, the Biden campaign. But time and time again, you'll hear from the Biden campaign and they'll say it is just too early. And at this moment, we are a year out and we haven't seen the millions of dollars that we will see unleashed on the American people when it comes to both of these campaigns.
They say it's too early. Where on the calendar does it become too late?
Well, that's a great question. I think first we need to get through these primaries, right? One nugget in this poll that really stood out to me is the fact that former South Carolina governor, former ambassador to the UN, Nikki Haley, who is doing very well in terms of some of these polls in Iowa and New Hampshire, she's in this poll in the New York Times, she beats Biden more significantly than the former President Trump would. But also interesting, Trump does much better than, say, Governor Ron DeSantis against Biden. And today we're going to have the Iowa governor, Kim Reynolds, come out and endorse, according to the Des Moines Register, come out and endorse Governor DeSantis. So I think we need to see how the next few months play out. But, Jonathan, they really start to unleash some of these funds, and Biden has to start campaigning within the next 6 months. He's going to try to do that today. He's going to be talking about Amtrak. He's going to be talking about Bidenomics. But the fact of the matter is, he is also embroiled right now in foreign policy. And what we see time and time again in these polls, that it's the economy that voters want to vote on.
All right, Anne-Marie, when you talk to people on the record in the administration, from the administration, they're going to say there's so much time, it's all noise. What's the sweat factor off the record when you have conversations?
I don't think some of this sweat factor is even off the record. We heard from Senator Richard Blumenthal, the Connecticut Democrat, over the weekend, talking on CNN's State of the Union, their Sunday show, and he said, I was nervous before the poll, and now I'm nervous after the poll. People do recognize that time and time again, one of the biggest concern that voters have in these polls, and it's not just about the current president, Joe Biden, but also about the former president, just not in as big as the numbers you're seeing, but people are concerned about the age of both these individuals, and obviously that's playing out more significantly for the current president, and that is happening within his own party. Look, he has a challenger now in someone like Dean Phillips of Minnesota, this congressman. That's someone that could potentially take votes away from the current president in key swing states. I continuously talk about 2016. Hillary Clinton lost Michigan by 10,704 votes. If the third party wasn't there, she could have potentially won.
How much is the issue with the Israel policy and what's going on in the Hamas-Israel war really crystallizing some of the tensions within the Democratic Party? Is there sort of a reckoning that President Biden has to face off with that seems to be percolating under the surface here?
I think there's two things to watch when it comes to Democratic Party, given the state of supporting Israel and how much they want to support Israel. One, you are seeing pushback and blowback to, say, Congresswoman Rashida Tlaib. Over the weekend, she put out this video. She said there's going to be a reckoning for you, Mr. President, talking to Joe Biden for 2024. And Bernie Sanders over the weekend said she is a friend, but if you're talking about from river to river, city to city, this chant, he said that this does not help. And I just want to read exactly what he said. He said, she's a friend, but slogans like from the river to the sea, if that's meant for the destruction of Israel, that's not going to work. So you do have individuals who are saying that she has gone way too far and they don't agree with her. But at the same time, you also hear from Democratic leaders in the Senate and Congress who say that the U.S. needs to make sure that they are pressuring Israel, which we do know they are doing behind the scenes, to stop them bombard it in terms of the civilian death casualties going up. And many of those civilians continue to be Palestinian children.
As we see that intense diplomacy and that pressure building, Anne-Marie, from the United States on the government in Israel, are you seeing any signs of success whatsoever?
We've seen a lot of frenetic diplomacy, not just on Israel, but also, Jonathan, now we have Secretary of State Antony Blinken making a surprise visit to Baghdad. Today he's in Turkey. So there's a lot of pressure. At the moment, what you hear from the Israelis is they are not going to stop until they get rid of Hamas. Of course, their issue, and administrative officials have spoken about this in public, is that Hamas has time and time again used schools, use refugee camps, use hospitals to place their infrastructure, to place their leaders. But as every day continues and bombs continue to attack Gaza, and you see pictures of these civilian death tolls rising, you see internet cut off, you see humanitarian aid struggling to get through, the calls are going to become much more louder from not just the president, but also other members of Congress and other leaders in the United States and around the world to pressure Israel for a ceasefire. Right now, what the U.S. is pressuring for is a pause for humanitarian aid, and potentially we may see one.
Anne-Marie, just over the weekend, we saw some pretty big protests, pro-Palestinian protests in the nation's capital, where you live, where you are. How difficult was it to draw a distinction between those in that group who had perhaps justified criticism of Israeli policy and those in that group who were just pushing blatant anti-Semitism?
Well, this is a big challenge. And this is what Senator Bernie Sanders was talking to over the weekend. He does not want to see Palestinian children die. And he says this is an incredibly complex problem. And what the issue is if you're at a protest, it's really hard to do nuance. And especially as even that chant that a lot of individuals will talk about at a protest, many take that as calling for the destruction of the state of Israel. And obviously, many in America, many in the Jewish community view that as anti-Semitic. And frankly, it is. But then you have individuals like Rashida Tlaib who says, no, I am just calling for peaceful, humanitarian, peaceful rights, human rights for Palestinian people. And that is why this is so challenging, Jonathan.
AMH, thanks for the update. Anne-Marie down in Washington. We've got to talk about some big numbers in Washington this week. $48 billion of 3-year notes get auctioned. Later this week, $40 billion of 10-year notes, $24 billion of 30-year bonds. That's a lot of supply. Amanda Lynham of BlackRock up next. Five-day winning streak on the S&P 500 about to become 6. Your equity market looks like this. We're positive on the S&P, on the Nasdaq through most of this morning, up 0.1% on the S&P 500. On the Nasdaq 100, up by 0.2. Five-day winning streak, the longest since June. The weekly move we saw yesterday, the biggest weekly move going back to November. Bramo on the S&P 500.
Just in honor of our guest coming up, if you take a look at the analog within the debt space, the credit space, we saw almost 0.75 percentage point plunge in yields of high yield bonds over 3 trading sessions. Just to give you a sense,
mental.
It's crazy if you take a look at just how wild and violent some of these swings were, and that is sort of the equity analog in credit.
Are we about to get whipsawed? Barclays. This note from Barclays this morning, getting a ton of buzz. I'll share the lead paragraph with you. The Fed held steady, shrugging off strong data on the pretext of tightened financial conditions, but this dovish turn may have backfired. They go on to say, with financial conditions easing significantly this week amid some softer data, we retain our view that data momentum will force another hike. Their call is early 24. It's January now, not December, but still, you come out and you start endorsing tighter financial conditions, doing some of the work for you and backing away, and all of a sudden, guess what? It's not doing the work for you anymore.
I love the chess game that seems to transpire between the market and the Fed. It's always kind of fun, where basically the Fed's trying to get the market to do the work for them, and the market's saying, well, I see you, so I'm going to get ahead of you, and I'm going to move to where you're going to be, and then you end up in this circle that's really fun for everyone trying to come up with your head outlooks. It's really good.
The headline from Barclays, the Fed is caught in a circularity loop.
See?
Just round. There you go. All right. In the bond market, 2-year, 10-year, 30-year. Let's get to the bond market. Treasuries through 5 2 weeks ago, back down to 459.53, up 2 basis points on a 10-year. Lisa also pulling back on a 2-year as well, 486.97. Last week, has the bar for more hikes got higher? Yes. Here's the question. Has the bar for cuts got lower?
That, I think, is the key question that people are going to look to. And what you're seeing in the market is yes. That seems to be the implication, especially given the fact that this Fed seems to be seeing something that the rest of the market maybe isn't, which is the reason why people are curious about the SLOOS later today. It's really fun to say that, the Senior Loan Officer Opinion Survey.
Is that why you're repeating it?
SLOOS. Okay. It's not that fun.
Later.
Anyway, but they're just curious to see whether that tightening is kind of in the pipeline and is going to get bled out in the long and variable lags that you love.
Okay. The epicenter of our world. Bonds. Yields down, dollar weaker, euro stronger. Best week for the euro against the dollar, that currency pair. Back to the summer, the month of July. 107.51 on this currency pair, positive here by 0.2%. Under surveillance this morning, US Secretary of State Antony Blinken in Turkey, trying to stop the conflict in the Middle East from spreading. Blinken also making an unscheduled stop in Baghdad over the weekend after meeting with the president of the Palestinian Authority in the West Bank. This was Blinken's first visit to the West Bank since the October 7th attacks by Hamas, and the pressure, we've been talking about this all weekend, Lisa, all morning, the pressure building on the administration is getting bigger and bigger.
And the inability maybe to put the pressure on the Israeli government, also a real point of question here, especially given the West Bank and some of the violence there that Tony Blinken said was absolutely unacceptable. They need to really tamp down on that from the Israeli side. Whether there's going to be some sort of response, again, unclear what kind of influence they have.
And that's foreign policy, foreign affairs, international politics. Let's talk about things domestically. Some good news from Republican presidential candidate Ron DeSantis, expecting a key endorsement today from Iowa Governor Kim Reynolds. Bloomberg reporting the governor will make the announcement at a rally today as former President Donald Trump maintains his lead across the Republican field. The Iowa caucuses are on January 15th. GOP candidates will take to the stage later this week. Third debate taking place, Bramo, on Wednesday.
You know, this to me is going to be a theme all for the rest of this year and also early next year. Are we really going to get a rematch of Trump versus Biden, or are we going to see new entrants? And I think that maybe after a number of these debates, there will be a question about whether former President Trump, A, needs to take part in some of these debates, and B, what the feasible kind of outlook is for this election with people who are actually elect a bull, given the unpopularity of those two candidates.
Let's just round out the greatest hits of stories that frustrate you. Here's the last one. The third one. House lawmakers working over the weekend on a stopgap measure to fund the US government beyond the November 17th deadline, according to House Speaker Mike Johnson. Johnson previously floated this new funding deadline of January 15th. Still waiting for details on that. So we're playing this game into what, this deadline in the middle of November?
I feel triggered right now. I'm not sure. I mean, this is just all triggering stuff.
This last story may or may not have been deliberate.
Well, the other ones are equally frustrating. This one is frustrating because it's such an unnecessity, like a lack of necessity to understand that we're going to get another shutdown. What I think is interesting is that Mike Johnson actually has taken a more moderate and conciliatory tack than a lot of people had expected, and is talking about pushing that deadline to early January in a more meaningful way. He had a different tone than some people had expected in the talk shows over the weekend.
I think we're all excited about this story for the next couple of months, aren't we? Amanda Lynham joins us now, head of macro credit research at BlackRock. Amanda, don't worry, we're not going to be talking about that. I do want to talk about supply, if we can start there. We've got $48 billion of 3-year notes this week. We've got $40 billion of 10-year notes. We've got some 30-year bonds, $24 billion worth. These are big, big numbers. That's Treasury supply. What's happening with credit supply going into year end?
Good morning. Thank you both for having me. So as you know, credit supply had a bit of a flurry of activity in September. It calmed down in October. I do think with this tentative stability in the Treasury market that corporates, CFOs, and treasurers may look to move ahead before the year-end seasonal slowdown. It will be an important test for the market how this Treasury supply is digested. But as we know, the Treasury Secretary guided us towards the front end of the curve and not so much in duration in the refunding announcement last week. But I actually think if nothing else, the past several months have shown corporates that this can be very episodic in terms of these windows opening. And so given that we know the maturity walls are coming up, I think for corporates, it's better to issue early rather than late. We're expecting a big week in the IG market this week. I think expectations are a little lower in high yield, but I would not be surprised if we surprise to the upside in terms of those expectations, because I think it's just prudent for CFOs.
Which speaks to kind of the opportunism that one syndicate desk told me about last week. He messaged me as soon as we saw this rally, and he said, everyone's trying to come to market. I've gotten 15 phone calls. Everyone's basically lined up. Is this going to be bad with credit spreads widening in this sort of counterintuitive way because we've got more supply?
Yeah. I think the appetite is there, and I think we've had such light supply, especially in high yield year to date, and 22 was a record low level, that I think the appetite for the market is there. I think where the real risk is at that lowest quality cohort of the CCC market, that kind of lowest quality rung of high yield, which are CCC issuers. There, I think we've seen some enhanced pressure where it's weak results coupled with refinancing needs have really pressured those capital structures, and even on this swift rally in high yield spreads that we've seen over the past few trading sessions, CCCs have rallied, but they've lagged on the way in. And I think it's the market telling you that there's an appetite for a certain quality cohort in the credit market. IG, I think, is there in most market conditions. High yield is a bit more tentative. But for that lowest quality rung, I think it's very case specific and very idiosyncratic.
Are people kind of just pricing in perfection here?
Well, with high yield spreads below 400, it's hard to argue that there's much risk premium added into the market at the moment. I think what we're seeing is a lot more focus on selectivity from our credit investors. So thinking about asset allocation between high yield and leverage loans, sector selection, issuer selection. I think where high yield spreads are at the moment, the path of least resistance is probably a little bit wider in terms of choppiness with some of the headline risk ahead of us. But again, as we've talked about before, where yields are, it's really difficult to see kind of high yield spreads breaking out in this range of much wider from here, because every time we tried to reach 440 last week and we kind of snapped back in. And so there is a bit of a tug of war between fundamentals and technicals, and even the most vulnerable fundamental pockets of the market have been the best performer, like leverage loans.
You mentioned the decision set between loans and, say, high yield. Help our audience understand what goes into making that kind of decision and whether that's changed in the last few weeks.
So it has changed in the last few weeks for a few reasons. One is if you think we're at the end of the rate hiking cycle, if you think we've seen stability in long end rates, you might think that the bulk of the loan outperformance is behind us at this point. And indeed, that yield pickup that leverage loans were offering over high yield bonds has narrowed. So what we are seeing is a bit more interest, say, even within capital structures of investors saying, OK, well, I'm in the loan. Should I rotate into the high yield bond? Or given the fundamental pressures of this higher for longer rate environment that we're expecting, are loans disproportionately impacted by that because they've been contending it with it for a longer time? Again, we don't view fixed rate bonds as immune from that in many instances. But I do think on the margin, given the strong performance of loans year to date, there is some refocusing on, OK, is the bulk of that loan performance behind us?
Breathe some life into that just a little bit more. We saw a big equity move last week.
Yep.
If you're looking at and I know it's unique and idiosyncratic, but ultimately just give us the 35,000 foot view. If you're looking down a capital structure right now, is the bias to be higher or lower in it?
Actually, I think the high end of the high yield market has actually outperformed the low end of the IG market. So it's not as clear cut as saying be underweight high yield versus IG. There are a lot of nuances there. I do think for choice, I would prefer to be higher in quality within high yield. In IG, I think moving down into that triple B cohort is a relatively nice place to be. For the most part, the vast majority of those corporates are committed to maintaining investment grade ratings. You are picking up a bit of a spread pickup relative to the highest rate cohort. And I think that's important in this current environment, especially if we don't get a severe downturn in growth.
So I don't mean to be overly basic about this, but when you take a step back, I do wonder if we do coalesce around this higher for longer kind of idea.
Yep.
Does it make sense that we're not going to get any kind of major default cycle, either in public credit or in private credit, if we're looking at benchmark rates that are 5 percentage points higher than when all of these companies were borrowing in bulk not so long ago?
It's a great point, Lisa. So we are seeing a modest uptick in defaults. We're at just under 5% in the U.S. when you combine high yield and leverage loans. That's well off the rock bottom levels of 2021 and 2022. Do we break out to the levels that we saw in COVID, 8.5%, 9%? I think barring a severe downturn, I don't see it. Part of the reason is that corporates have entered this period in a really strong position. The other part is that the investor appetite, to your point, John, is there. And then third, I would say corporates are actually shifting to a more balance sheet friendly posture. So we haven't seen a lot of debt funded M&A. We haven't seen a lot of debt funded share buybacks. They're still investing in CapEx, still investing in debt repayment in terms of uses of cash. But I do think corporates do have some discipline. I think the real risk is that if there's a severe downturn in growth coupled with just a capital markets freezing such that these corporates don't have access at any price, I think it's difficult. As for the private credit point, historically we look at losses between the two markets, and private credit losses have held in better than public credit losses. Part of that is because the enhanced flexibility that those corporates have. We think that holds true, but I think the point remains we're expecting an ongoing normalization higher in losses across all those asset classes. Not extreme though.
Given where we know where the maturity wall is,
yes,
can you identify what would be the least optimal time to have an economic downturn? And is that what's basically on the horizon now?
So I think probably the biggest risk is that if corporates try and time this opportunistically, they let the year end play out, they think the environment will be better in the first half of 2024, and then we have some sort of shock, whether that's geopolitical, unforeseen risk contraction. We're watching bank lending very closely, although that has actually played out, I think, a bit more benign than we would have thought. That is the risk. I think that if corporates try to be almost too strategic about the timing and they cut it too close, we saw that in the financial crisis where some corporates were shut out. So that's why I think if I'm a CFO or a treasurer, better to issue early rather than late.
To Lisa's point, maybe we get a lot more supply in the coming weeks and months based on what we've seen develop over the last few weeks. Amanda, thank you. Always great. Amanda Lynham there of BlackRock. If you are just joining us, welcome to the program. Your S&P 500 positive here by 0.2%. Your bond market yields up by a couple of basis points, 459.53 on a 10-year yield. Let's go through that supply again, Bramo. We're going to get 3-year notes, $48 billion worth. We'll get them tomorrow. Day after, $40 billion of 10 years. Day after, $24 billion of 30-year bonds.
Is the fire over? Have we basically seen some of the bad auctions, and based on the idea of a lack of certainty around Treasury refinancing? That, I think, is actually key. It might be some of the most important data points of this week. If we do get orderly auctions that really do have good technicals, do people get conviction that we've seen a peak in yields?
I think that conviction started to build already.
I mean, for now, wait 2 minutes.
Basis point move, Bramo.
Wait 2 minutes, and then suddenly everybody will be on the other side.
A lot of enthusiasm that maybe that is the case.
Enthusiasm is a good word.
That you don't share.
Well, I just don't know. I mean, honestly, when you're playing ping pong roulette.
Nobody really knows.
I mean, it's just a frustrating kind of moment that's lacking nuance.
Nobody knows, that's for sure. What are we calling this? Ping pong roulette?
Yes, it's
a very different game now, Bramo. Okay. Coming up in about 30 minutes' time, Michael O'Leary of Ryanair. As they come out with earnings today, that stock is up by about 7%. Michael O'Leary, a little bit later next hour.
In every war, there are unintended consequences and there's collateral damage. That's tragic. Every human life is tragic, Palestinian or Israeli, doesn't matter. We act according to international law. We make every distinction that we can make between civilians and terrorists. This is tragic, but we cannot allow Hamas immunity just because they hide behind civilians. We want to separate between the two and strike the terrorists.
That was Michael Herzog there, the Israeli ambassador to the United States, speaking on CBS over the weekend from New York. Welcome to the programme as we kick off a brand new trading week. Your S&P 500 shaping up as follows. Equities pushing higher through most of this morning, up by 0.2%, pushing much, much higher through last week on the S&P 500. The gains last week, Lisa, close to 6% on the S&P.
And it was driven by banks, it was driven by utilities, it was driven by also big tech, it was driven by all of the winners as well as some of the losers. Broad-based, kind of continue. And honestly, this morning it seems like people are getting conviction that maybe this has lasting power.
Note just dropped from Evercore. We expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing of financial conditions. Barclays talked about how circular this is. That's going to continue maybe this week.
So what are they going to say?
No
that
idea.
Things have gone too far? We're targeting 4.8% on the 10-year. Please get with the program. I mean, honestly, at a certain point, how specific do they have to be versus just be agnostic and say, we don't know exactly what's going to happen?
Neil Datta of Renmac just wrote in as well. So if you stay tuned, I'll give you the Neil Datta take on things in about 5 minutes' time. Look out for that. Let's start in the Middle East. I'm pleased to say that joining us now is retired Lieutenant Colonel Daniel Davis, the Senior Fellow at Defence Priorities. Colonel Davis, thank you for being with us, sir. I know something you'd like to talk about is something we'd also like to talk about. Maintaining a troop presence, the United States in places like Iraq, in Syria. Can you help us understand whether the benefits of doing that outweigh the risks?
Well, I argue and have for many years, not only does it not benefit us, it gives us nothing but a strategic vulnerability. In 2019, in May 2019, President Trump then tried for the third time to say, I'm going to withdraw all our troops from Syria. And I was an advocate of that. And I went on Fox News and I said, look, we need to get these guys out of there. He needs to succeed with that because all it does is provide an opportunity for some of these Iran-backed groups or other kind of Islamic groups to just target them. If you take those troops out, then we have no point of vulnerability. If those troops were there and doing something of value to the United States and they were necessary for our security, then it might be worth the risk. They aren't. There is no value to our country at all. They are almost purely a vulnerability. And now it's going to be harder to take them out because people are going to be afraid of, but it'll cause, that people will think we're weak or that we're forced out. Look, they'll say whatever they want to say, but you can't leave American troops there and just leave a ticking time bomb until one of them gets killed. And then you have to actually decide whether you're going to strike possibly even Iran and get us drawn into a war. Nothing is worth that.
Colonel Davis, would you acknowledge that the decision to withdraw them now, since the events of several weeks ago, is a harder one to make, or is it an easier one to make?
Oh, absolutely. 100% it's a harder one to make. It's still the right one to make. Because consider this, if we don't make that decision and say, well, people will say all those things, and then Americans get killed, and then the president is forced having to make a decision to strike Iran, which could draw a war, that would be catastrophically worse than what people may think or say now. So I still think it's necessary, but it's much harder politically, especially.
Colonel Davis, when we talk about the philosophy of deterrence, how do you understand some of the aircraft carriers and other types of military ships in the Mediterranean right now? Do you think that that is an effective strategy of deterrence?
Well, it's a big risk, I'll tell you. There's pros and cons, because when you have that much firepower, it definitely causes anyone to give second thoughts to whether they should test us and go in and whether we would surprise. Let's say, first of all, with Hezbollah in the north. There's been many people in the United States, suggest that we should get involved if Hezbollah goes against Israel, or if anything else happens with Iran, then we have to go in with there. We want to deter them both. And that much firepower is causing a deterrence on both. But it comes with a risk, because whether someone through miscalculation or a foolish decision or a rogue actor in the region, and there's plenty of them, if they take action that then causes us to have to use that, then that could be the very thing that sparks us into a war. So it's a double-edged sword.
And Colonel, it's coming at a time where there are a lot of questions around morale of our troops. And I'm wondering, from your vantage point, how you see that evolving right now as the U.S. gets more involved in conflicts, whether it's in Israel or potentially on the border of Ukraine.
Well, look, I'm sure that everybody who volunteered was very similar in one regard to when I volunteered to serve. And that is, we just said we want to join our force to defend America. If we're attacked, we want to defend our interests. And if necessary, we're willing to even lay our lives down for that. There's no one that I know of that would dispute any of that. What we didn't do is say, hey, we want to put our lives on the risk for some other government, like Iraq. We have troops on the ground in Iraq that are helping Baghdad. They're not helping us. Or in Syria, that's helping the SDF, Syrian Democratic Forces, not us. Or ad infinitum. There's so many places where it's helping other countries, it's not helping us. And it's not a good thing for, like, say, the family members. When people are thinking about joining up, do you really want to have your kid go in and maybe just be a pawn in the middle of the desert that's not even necessary for our security? It definitely has an impact, and it's not a good one.
Colonel Davis, every Monday we talk about another weekend of intense diplomacy between Secretary Blinken and a range of countries. I know you've got your own personal thoughts on where and which country we should maybe be talking to a whole lot more. Can we talk about Turkey? Colonel Davis, what is going on with our relationship with Turkey?
Yeah, that's the biggest one right now, because it's the most pointed and the most potential risk one for us. And Blinken is there right now as we speak. He had a meeting this morning with some of the senior members of the Turkish government, but he's not going to have a meeting with Erdogan. So that's a first signal that Turkey's sending that, hey, we're upset and we're not looking to, just do whatever you want to do. But you're talking about a NATO ally who is, emphatically against Israel, and here they are openly for Hamas, and they're openly against the United States and openly against the West. So there is a real breach here and a potential problem, because you talk about the possibility of Iran maybe getting involved in this war, but if it's Turkey that gets involved with this war, you have catastrophic problems, because that's a NATO ally. Then what are you going to do? So it is crucial and vitally important that we get this right, and that has to take priority, the strategic issue for the U.S. over, any issue that may be going on between Hamas and Israel. As important as that is, we've got to look for our interest, that we don't harm our interest. That would be across the board a big problem.
When you think about their potential involvement, and I stress potential because we don't know if that's going to happen, but let's play that forward a couple of steps. What would that involvement look like?
Well, look, unfortunately, there's a wide range of things that could look like. Whether Turkey gives potentially just moral support to Hamas, takes actions maybe even behind the scenes or off the front pages against Israel, or maybe even breaks out of NATO and says, hey, we're just done with the West. We're tired of, all of these, double speak is what they're accusing us of in many cases. There's a lot of things. And of course, the worst case scenario, it could be he could make good on his claim that we're going to actively help the Hamas side or Hezbollah, anything against the Israel. And you have some real problems if that starts to happen.
Daniel, appreciate your perspective this morning. Let's do this again soon. That was Daniel Davis of Defence Priorities, the retired Lieutenant Colonel. Lisa, pressure on this administration from, as we've said all morning, all directions.
It's all directions. It's within each party, because there is a question also of the importance of preventing a wider altercation in the Middle East, and the U.S.'s role and historical role in doing that, and how you do that while maintaining support and actually not ending up on the wrong side of the conflict.
Now, I promised you one thing, didn't I? Neil Dutta, the view on the Federal Reserve. Interesting view from Neil. Different. Unemployment has increased while wage growth has slowed to a pace consistent with their underlying inflation objective. What's changed for the Fed is they can credibly point to the labour market data of late and say they have achieved a rebalancing. Put differently, they can't use the job market to stay hawkish. That's your view from Neil this morning. That alone reason to think about the Fed surgically cutting interest rates?
That's Neil Dutta.
That's Neil Dutta of Renmac.
That is a real flip in his view, where he was talking about the potential for a real increase in inflation. So now my question to him, and we'll have to get him on to actually answer this, is does that mean that he is taking back some of this belief that we are in a new higher rate regime that's eventually, going to have some sort of consequence, or is he basically the sort of bad news that he was expecting down the line?
Cutting back to what? That's a question we can ask. I think he's raising a point that we can now think about surgically cutting interest rates, which is not going any further, but ultimately reducing them in line with this drop-off in inflation pressure, which is, I think, where the market is going into 2024.
Surgical?
Yeah, you can ask him what he thinks that means. Mandy Zhu of Sivo Global Markets joining us in just about 5-10 minutes' time. Your equity market on the S&P positive here by 0.1% on the S&P 500, following the biggest weekly gain on the S&P of the year so far. We are on a 5-day winning streak, which could become 6.
You look at the cracks that are developing, I think there's a decent chance that the Fed may have to cut a lot more.
We do think that's still a heightened risk environment.
We are seeing pockets of weakness.
I'm talking about a hardish landing. I really don't see how the economy can continue on in this way.
Whether it's soft landing or hardish landing or hard landing will remain to be seen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK back in a couple of days, getting your week started with equities positive once again after a massive week of gains on the S&P 500, higher by close to 6%. And the dovish language continues this morning. Deutsche Bank, Brett Ryan, the Fed is done. We've heard that from HSBC as well. Goldilocks is back. This from Neil Dutta of Renmac. The doves can take out the hawks in December at the Federal Reserve.
Which raises this question, how do you do that without loosening financial conditions so substantially that you have to go the other way? This is the cyclical kind of moment that we're in that is head spinning. And if you're waking up and saying, are you guys going to keep going with this? Yes, unfortunately we are, because we have no other choice. This is essentially the cards that we've been dealt. And essentially that is where the Fed is going to be stuck between a rock and a hard place in how they message.
Financial conditions are too tight. Yeah. The moment you say that, what happens?
Boom.
Yields plunge, equities rally aggressively, credit spreads tighten, and the dollar weakens.
Exactly.
That was last week, wasn't it?
So essentially, are they going to be gaming the market? Are they going to be market timers the way that the Treasury Department seems to be? And you have basically two market timers that are trying to pin a market in between what particular range. And do we get that kind of situation over the next couple of months?
So this week we don't get data, we get Fed speak.
Correct.
Right, including Chairman Powell. Evercore out with a note this morning saying we expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing financial conditions. Once you start doing this, you can't put it back in the bottle. The toothpaste is out of the tube, isn't it? You go week to week trying to manage financial conditions. Is that really going to happen?
It could very well happen. It sort of depends on whether we have some sort of lodestar with respect to the data. And so far, we've had a real sort of divergence with confusing and noisy data that is typical at the end of a cycle or close to the end of a cycle. So the question is, when is that moment that we reach a tipping point where the data speaks for itself and there is a clear trend? And until then, are we going to be playing, pickleball?
Pickleball now. Okay. Why don't we just go with James Athey's turn?
I'm trying to sort of diversify.
James Athey of Aberdeen just called it
ping pong.
No, he called it narrative table tennis, didn't he?
Well, same thing.
Yeah, ping pong, same game, but missing a word.
Well,
just
whatever.
Narrative ping pong, if you want to call it that.
I think we should do pickleball because I actually saw a pickleball match this weekend, and I could understand a little bit more.
You went to watch a competitive one?
No, I went to the park and there were
like
pickleball
walk past one. Were you tempted to play? I hate the noise. The noise does my head in.
Yeah, it's a different kind of ball.
I hate the noise.
Why? But it looks kind of fun, though, doesn't it?
There's people playing it at like 8 in the morning. And if you live by one of those courts, just back and forth, no thank you. Big rally in the bond market last week into this. A massive slate of supply coming up. We'll get 3-year notes, 10-year notes, 30-year bonds. That's a lot of supply coming this week, Lisa. Just going through the numbers, 48 billion, 40 billion, 24 billion, respectively.
Arguably, this is what led off the rally, and arguably this is what was underscoring it for so much of last week when it became clear that the Treasury Department was very attuned to the market dynamics in a significant way. So here's the issue. If we get a disruptive kind of auction, how problematic is that going to be for the idea that maybe we've seen the peak in yields? That, to me, will be the most instructive aspect of this particular week.
Jeff Yu, BNY Mellon, earlier this morning on this program said we could retest yields from where they were 2 weeks ago. Doesn't think this is over.
And other people would agree with that simply because if you take a look at inflation, it's not going away. That said, are we seeing potentially the softening in the labor market data that could justify people making whatever argument they want? This is going to be fun.
It's going to be fun. Is that what you call this?
Well, I mean,
my message,
this is what we're dealing
my message
with.
board this morning on my Bloomberg just lighting up with recency bias.
Exactly.
Just extrapolating out the last week price action, which is bonds rally, equities rally, yields drop, dollar weakens, credit does well, spreads tighten, and all the good stuff.
In fairness to the recency bias, and to be completely clear, people who have traded on a theory of recession have failed.
Yeah, that hasn't worked.
Right. People who have traded on the theory that 60-40 would work again also have failed. People who have traded on the idea that eventually big tech would roll over with higher yields, that's failed. So what theory has worked other than recency bias and riding momentum?
60-40 was awesome last week.
Exactly.
Just everything.
It's either awesome or terrible.
Equities look like this on the S&P 500, positive here by 0.1%. Big rally last week on the S&P and on the Nasdaq. Big rally in the bond market too. Yields aggressively lower. This morning higher by 3 basis points. I think we can call it 460. Surprise of the year so far. There have been many. Surprise of October. Just the fact that crude was down as much as it was in October, Lisa. It's kind of stunning. Down by something like 11%. This morning we're higher by a single percentage point to 81.52.
Again, try to come up with some sort of theory. Geopolitical risk, oil prices higher, failed. I mean, again and again, we're just seeing one narrative after another torpedoed in actuality because of all of the different myriad factors that are playing into this. It is mind-spinning.
Let's try and come up with a theory with Mandy Zhu, Vice President, Global Head of Derivative Markets Intelligence over at SIBO Markets. Mandy, good morning to you.
Good morning. I'll take a stab at the narrative ping pong.
Or pickleball, or whatever Bramo wants to call it. Okay.
Pickleball.
Max Kettner, HSBC, said this morning, Lisa quoted it, I'll cite it right now, the MOVE index is the new risky asset fear gauge. What would you say back to that?
So certainly bond volatility is the highest across asset classes right now, but I don't think it is the only measure that investors are looking at. And obviously, I'm not just saying that because I work for the SIBO, but I would say the VIX index, more so than any other, is what traders have up on their screen. But to be fair, I think right now we need to look across multiple asset classes, rates, equities, credit, right? We recently launched the credit VIX indices to give investors a better gauge to measure credit volatility. All of these are important asset classes to watch for as we kind of go into the potential end of cycle, as we talk about recession versus soft landing.
Is there anything about the price action and moves we saw last week that would give you some indication as to whether it's sustainable or not?
So to me, the price action of the past, not just last week, but the past 2 months have been extremely telling in terms of what the pain points are in people's portfolio. And it's not to the downside, right? The pullback that we saw in September and October were very, very orderly. And that's because coming into the fall, the consensus investor expectation was for a pullback. And what you really saw the pain was last week in the snapback rally, right? We saw people actually scramble for that upside because they weren't positioned for it. So if you look at, for example, S&P put call ratio hit almost a 1-year low as people were kind of buying those upside calls to really get that upside exposure that they don't have in their portfolio.
I love this, by the way, that the pain trade is when things do too well and that people got knocked out because there was a rally. Well, I mean, this is sort of where we are in this moment of upside down and downside up. But my question to you is, have we washed that out? Are we done with the positioning that causes the pain trade to be further upside?
I don't think so. I think, again, we talk about the narrative ping pong, but I do think the consensus, and even though economists have shifted to soft landing, I think if you talk to investors, everyone is still so bearish. And the positioning, to me, it's going to take longer to really wash out than what we saw last week. And that's why we're seeing that durable demand for those upside calls in the S&P.
When we talk about upside, yes. Are we talking big tech upside? That basically is what people have not loved because they've believed that higher yields might take away some of that valuation, that people are being forced to buy those once again.
I think part of it, there certainly has been, I think one of the distinguishing features of this year's price action has been the incredible sector dispersion. And we talked about the narrative ping pong. The ping pong between sector leadership, right? Last year, tech down 40. This year, tech up 30, 40%. That changing sector leadership, that high dispersion in the market is part of the reason why volatility in the equity market at the index level has been so muted. It's because of those wild swings that we're seeing at the sector and the stock level.
How correlated have the bond and stock moves been? In other words, is there just a direct read-through? Lower yields, stocks rally, rally, higher yields, stocks meander because people aren't positioned in them too much.
So if we zoom out from just the past week and look at over the past year, it's been incredibly unstable. So that's, I think, the key feature is the equity bond correlation has not normalized to what people are used to. And because of that instability, I think is one of the reasons we're seeing more and more people gravitate toward equity specific hedges, so options, right? Because if fixed income is no longer diversifying your equity risk in your portfolio, you need to look at more specific hedges. So, buying those S&P puts or other types of hedges. I think that's kind of been the trend, and that's why, option volumes have been hitting record highs all year.
A note that just caught my eye from Citi, Andrew Honhorst, he said soft patch, not soft landing. There's a difference. He says, rather than a steady slowing in job growth and inflation, our near-term projections suggest a temporary soft patch. Elevated inflation is likely to be more evident in upcoming data. Last week's reloosening of financial conditions also argues, in his eyes, against the moderation in activity and inflation. Mandy, does that argue that we should be much more nimble as we work through this? Lisa kind of mentioned this, and we were quite snarky about it earlier on in the programme.
Yeah.
It's difficult to make projections for the next 12 months. You can't cling to a theory at the moment when everything seems to change. It's painful in bonds. You'll get whipsawed in one direction, and the next week, whipsawed in the other. Does that argue to be nimble, and what does that look like from your perspective?
Yeah, so I alluded to earlier, so absolutely, the heightened macro uncertainty means that investors do need to be nimble, and the way they're doing that is through using options, right? And the way that I like to explain is, if there's no uncertainty and stocks are going up, you just buy the underlying, right? You just buy the Delta One, instrument. It's when you're uncertain, when you want defined risk reward, right? You want to know what you're at risk of losing if you're wrong. That argues for using options, right? If you buy a call option, going into the trade, the max that you can lose is the premium paid. I think that's why, again, in this uncertain macro environment, even though it hasn't translated into higher levels of VIX being 30-day measure of uncertainty, that long-term uncertainty has definitely led to more and more people using options to kind of define that risk reward to help manage that portfolio volatility.
You touched on it there just slightly.
Yes.
When you talk about volume in options, are we talking about 0 day to expiry?
No. So people often think, okay, everything's coming from 0 day to expiry options. Volume across all tenors are growing higher, but obviously 0 day has been the fastest growing segment.
You've made the argument that's not something we should worry about.
No, and because it's balanced. So people who make the argument that 0 day options are what's driving the market, they look at the gross volume, the notional volume, and they say, well, look, it's 500 billion a day. Of course, that's what's driving the market. But if 50% of that is buy, 50% of the customer selling, then there's net zero impact, right? So the balance of that trading matters, and what we see is that it's incredibly balanced. And because that's the case, there's actually very minimal market disruption.
Mandy, this was great. Always is. Mandy Zhu of SIBO. Mandy, thank you.
Thank you.
If you're just joining the programme, welcome. Your S&P 500 positive here by 0.1%. Yields higher by 3 basis points. Your 10-year 460.57. Tons of dollar weakness last week. 107.42 on that currency pair right now. We're positive there by 0.1%. You've started something, Bramo. I'm not sure what you've started, but Jim Bianco, try and explain this to me. Andy Roddick, former number 1 in 2003 US Open winner, called pickleball diabetes tennis. Do you want to explain to me what diabetes tennis is?
Not particularly.
No?
I think maybe, I have no idea. Maybe because you don't have to move around as much for tennis. I don't know what else it could possibly mean.
Actually a quote from Andy Roddick. Jim Bianco's got to explain himself.
He's going to have to explain himself. He can come on and explain it better than I can. I just know that you don't have to run as much. That was one observation, because the courts are smaller, so arguably maybe you don't have to be as fit. But I'm not going to say that because it looked fun to me. And I know you have a personal problem with it because you don't like the noise of it.
I've had a lot of people write to me as soon as I said it. It's the noise. People don't like the noise.
Can you actually hear that from your apartment?
Not from mine, but as I go on walks sometimes, I don't like it.
And it triggers
disruptive. I wouldn't say...
Disruptive.
I'm not triggered by it, but I find it disruptive, yes. On an early morning walk on a weekend, Bramo, and you go past the pickleball court, that noise, I don't need that in my life.
It's like it's a slapping sound rather than the sort of like
and is it really
hollow ball.
Exercise? Is it?
I mean,
sort of like,
have you ever played ping pong? I can work up a sweat in ping pong.
Can you? All right. And pickleball.
I've never played pickleball. Full story.
Coming up, stay tuned. Michael O'Leary, Ryanair CEO, joining us around the table to talk about their recent numbers, plus the latest from Boeing and whether this company can get enough planes from that company. Looking elsewhere, looking at your equity market right now, there is a lift once again, up by 0.1% on the S&P 500. The rally in the bond market last week replaced with just a little bit of a sell-off. Yields higher now by 4 basis points. Lots of supply from Treasury this week. Your 10-year 460.98. Live from New York City this morning. Good morning.
I think we're going to have a good landing with respect to the confluence of financial variables we're talking about. We have a consumer in our country that is reasonably in good shape. The reality is that you got winners and losers in this economy, and the goods sector that people accelerated purchases during the pandemic aren't maybe doing as well. But if you live in the experience economy, who most of us do, it's doing quite well. If you look at our planes are full. Our planes are full almost everywhere you go, particularly internationally. That
was Ed Bastian, the Delta CEO, speaking with Alex Steele and Guy Johnson last month. Michael O'Leary with us around the table, the Ryanair CEO. Michael, I wish people could see your face as Ed Bastian was speaking, just to get some reaction. It's good to see you. Good morning.
It's great to be here, John, Lisa. Good to talk to you again.
Well, thank you, buddy. You've had earnings out this morning. We've been talking about this dividend of 400 million euros. We've got to talk about this relationship with Boeing. I want to share a couple of quotes with you and then try and get some clarity. So you said in the last week, if anything, it's getting worse. I would have been reasonably confident up until about a month ago that we'd get 57 aircraft by the end of June. I'm not confident. We heard from your CFO this morning, said the worst case scenario is that we'll end up with growth of 47 aircraft next summer instead of 57. Help me understand where things are. What did you want and what do you think you're going to get?
Yeah, I mean, in our case, Boeing are contracted to deliver us 57 aircraft by the end of April 24. In other words, 57 additional aircraft for summer 24. At the moment, that has slipped by the Spirit production issues in Wichita, Boeing's own production issues in Seattle. I think now it looks like they'll leave us maybe 10 short by about the end of June. We're hopeful we get 45, 50 aircraft by the end of June. And we've said to Boeing, we're not taking planes in July and August because, frankly, we're too busy. But we're reasonably hopeful that we'll get 45, 50 aircraft from. They will leave us short. I think that's inevitable at this point in time, which means we'll have slightly slower growth next summer, but we'll still add 45 aircraft. It'll still be enough to enable us to grow traffic from 183 million passengers this year to just over 200 million passengers.
Is there a number you have in mind whereby you would have to cut capacity for next summer?
There isn't. I mean, we haven't yet announced what the capacity will be next summer. As we said this morning, we have 90% of our summer 24 capacity already on sale, strong forward bookings, good pricing. But we can't commit to the last 10% until we get a better picture from Boeing. I speak weekly with Dave Calhoun. I think he's doing a good job in difficult circumstances. I've less faith in the management in Seattle, but I think, we're working closely with them. We have our own people in Seattle, we have our own people in Spirit and Wichita, and anything we can do to expedite these deliveries we'll do, because growth is so strong in Europe.
What is it about the management in Seattle? What are they getting wrong?
I think there isn't enough focus there on a daily basis on how do we get more of these aircraft out. Everybody is kind of wringing their hands, blaming Wichita. A lot of the issues are in Seattle as well. They need a more crisis. I would like to see greater crisis management in Seattle and greater focus on quality control. I don't understand how Wichita, Spirit and Wichita are able to have this succession of production problems if Boeing's quality control was up to speed.
Do you have options?
Options in terms of?
What do you do if you don't want to work with Boeing anymore?
No. Let's say we want to work with Boeing. We're Boeing's biggest customer by a mile in Europe. We're a committed Boeing customer. Now, I would buy Airbus aircraft if they were 5% cheaper per seat than Boeing. But Boeing continued to beat Airbus on pricing. The 737 MAX is a phenomenal aircraft. We now, this summer, we've flown 125 of the MAX 8 aircraft. We're carrying 4% more passengers, but burning 16% less fuel. They're transformative in terms of the engine and aircraft efficiency. We've ordered 300 MAX 10s, which will allow us to carry 228 passengers per flight and burn 20% less fuel. So they're making great aircraft. It's just they're not making them on time or delivering them in time.
Is it fair to say, though, this is a relationship you're stuck with regardless of what it delivers next year?
I mean, yes, we're committed to Boeing. If you look around the world, the aircraft manufacturers, Airbus are no better than Boeing at the moment. Airbus are way behind on their deliveries too. You have the Pratt & Whitney engine, which is going to be a real crisis next summer, across the A320 fleet in Europe. The Pratt & Whitney engine is going to ground a significant number of Airbus aircraft next summer. So all of the aircraft manufacturers are challenged. We're a very proud Boeing customer. I think Boeing will get its act together. It's just taking a bit longer than we had originally hoped.
In the meantime, how far can you jack up prices if capacity is constrained?
I think that the real issue for Elisa is not how much will we jack up prices, how much will Lufthansa, Air France, IAG or BA keep jacking up prices, and the answer is a lot. Eurocontrol estimate this summer Europe's operated about 94% of pre-COVID capacity. That includes us growing by 25%. So take Ryanair away, Europe's still at less than 90% of pre-COVID capacity. That's not changing next year. The aircraft manufacturers are delivering aircraft late. The Pratt & Whitney will mean 5-10% of the Airbus fleet will be grounded. And consolidation, Lufthansa will buy Alitalia, somebody else will buy TAP, and there'll be even less capacity on offer.
Okay, so this is good news for you because you don't have to really have to try too hard to be the lowest cost aircraft while still raising prices. How much are you going to raise prices next year?
We're price passive, load factor active. I think what's happening is how much, if Lufthansa, Air France, KLM will drive up fares, I think by a double-digit number next year, it'll send even more people in the direction of Ryanair. People want to keep flying, families want to go on holidays, they just don't want to pay Lufthansa's outrageous prices. So I think fares that next year, my operating assumption is fares will go up by a low double-digit percentage again through the summer of 24. It'll be the third summer in a row we'll see double-digit fare increases in Europe.
This is the first year, the first time that you're initiating a dividend.
Yep.
It's a £400 dividend. It is the first time. Does this mean that you have nothing else to do with that money?
Essentially, yes. It's not the first time we've done special dividends and share buybacks. We've done about $7 billion in share buybacks and special dividends. But, we're clearly generating a lot of cash at the moment. We've paid down about $2 billion in debt. We're down to our last $2 billion in bond debt. We'll pay that down over the next 3 years. And we're generating more cash than we know what to do with. We have specific requirements. Firstly was to do pay increases for our people who worked with us during COVID. Secondly was to pay down the bonds. And thirdly is to fund aircraft deliveries. But we're running out of the existing order. We take the last aircraft in December 2024. The first of the MAX 10s doesn't arrive till January 27. So we're looking into 2 or 3 years where we have effectively very little uses for cash. And I think it's a commitment on our part. We'll return to shareholders. We won't squander it the way many other airlines do in M&A or buying hotels or whatever, or as Delta would do, giving monstrous pay increases to its pilots over the next 4 or 5 years. We need to keep our costs low, keep our efficiency high, and keep passing on unbeatable airfares to our customers.
Do you think shareholders then can expect more of the same over the next few years?
I think so. As long as trading continues, who knows what's going to happen in Ukraine or in the Middle East, but as long as we get a reasonable wind on trading, then I think we will continue to be very cash generative and we will return large amounts of cash to shareholders.
It's hard to know what is going to happen in Ukraine, in the Middle East. I don't expect you to give us a projection. I do want to understand, though, are you seeing things slow down in any way, shape or form when you start to see these things escalate? Anything at all?
No, we saw the initial, when Russia invaded Ukraine in February 2022, or 22 or 3, I can't remember, there was a sudden downturn in all of our traffic into Poland, Romania, those countries. It recovered after 2 or 3 weeks. We've had to we're suspending all flights. We've about 30 flights a day into Tel Aviv. They've been suspended until Christmas. So we do want to see those scenarios resolve themselves. But the ultimate underlying trend across Europe, we've locked up everybody for 2 years in COVID. They all want to go back travelling. Families want to go on holidays. We've just completed the October midterm break. We were still full. And I think what people want is to travel more, but there's only 90% of the pre-COVID capacity. So in Europe, you've constrained capacity, enormous demand, and that is resulting in very strong pricing, not just for Ryanair, but for all of the airlines.
Are you noticing any trade down? I hate to describe it as trade down from BA to Ryanair, but are you noticing anything like that?
Not at the moment.
Okay.
But, I think it's inevitable if the next year or two, if consumers are under pressure, I think, you'll see the Lidl and Aldi's of the supermarkets, IKEA will do very well, and Ryanair will do very well.
So what about using some of the cash to make the experience nicer for people who might be frustrated with the experience?
Lisa, it'd be impossible to make the experience on Ryanair any nicer. New aircraft, on-time flights, the fewest cancellations of any airline in Europe. I mean, I don't understand why people pay such ridiculous airfares for a horrendous experience on Lufthansa, who lose your bag, miss your connection. On Ryanair, it's efficient, it's cheap, it's on time, and it is beloved
sound like a man that might
by
have lost some luggage
184
through
million
Frankfurt
people.
once upon a time.
Did you? Did you lose luggage?
I had to do I went on a road show a year ago. I had to fly from Frankfurt to Zurich, which is only about a 1.5 hour flight.
Sure.
They stung me for €900 one way in economy. And I was sitting at the back in the middle seat in front of the toilet on an Edelweiss A320. I mean, €700, I could fly all year round on Ryanair for €700.
Michael, it's good to see you. Thanks
Great
for joining
to see you,
us.
John, Lisa. Thanks.
Fantastic,
Thank
as
you so
always.
much.
Great to see you.
Michael O'Leary there, the Ryanair CEO. Next hour on Bloomberg TV, here's the lineup for you. Tony Dwyer of Canaccord Genuity, Stuart Kaiser of Citi, Laurie Heinel of State Street as we start a brand new trading week following a stellar week of gains in this equity market. Equity futures positive here by 0.1% on the S&P 500. Live from New York City this morning. Good morning.
The biggest of the rally of the year last week, and it continues today. Welcome back. This is Bloomberg Surveillance. John went off to prepare for his 9 a.m. hour. We can see a lift to the market after last week. Incredible rally, particularly in banks, as we've been talking about, in addition to the NASDAQ. Right now, you also are seeing ongoing dollar weakness, 107.4 on the euro-dollar spread. You're seeing S&P futures come back from some of the earlier highs, up about just 0.1%, and yields very quiescent here, kind of inching upwards as the session grows older, now up 4 basis points, 4.61%. A real question on whether we've seen the highs underpinning some of the confidence or lack thereof among market participants. We talk about the geopolitical risks, we talk about the political risks, and we haven't really talked about the potential government shutdown that is 12 days away should there be no agreement in Congress. Emery Herdern joining us now to discuss, Bloomberg congressional correspondent. Anne-Marie, is there actual progress getting made on how to stave off some sort of government shutdown at a kind of tumultuous time, both geopolitically and domestically from an economic perspective?
Well, it feels like deja vu in Washington because we literally just had this debate and it cost Speaker Kevin McCarthy his job. But there does seem to be a honeymoon grace period for this new Speaker, Mike Johnson. And what you see him trying to do, when he talked about over the weekend on Fox News Sunday, is that they're going to continue to work to advance these single appropriation bills, and a lot of them are conservative. So this is one way, in terms of a strategy he has, is really to pacify or placate to the hard right flank of his party, and then potentially they're not going to get all these appropriation bills done by next Friday, November 17th, when there could be a government shutdown, when the government runs out of funding, and then he'll have some wiggle room to bring a continuing resolution to the floor. How he does that is going to be interesting. He at one point mentioned this ladder approach, so funding the government in a staggered way, potentially funding certain agencies at certain dates. He's also talked about going till January 15th or even April 15th to give his caucus and to give all of the House of Representatives more time to fund the appropriation bills. So these are the potential options we can see in the coming next 2 weeks before the government would end up running out of money.
It raises a question, especially ahead of Wednesday's debate, where we're going to be hearing possibly what the candidates' proposals are for the economy, where they would like to cut, and how much bond yields are very much in the forefront of their minds as they think about how to reduce the deficit. What do you expect, and how focal do you think the economy will be in Miami on Wednesday at 8 p.m.?
Well, I think it'll be top of the agenda for this debate on top of foreign policy, because that is what is happening right now. And that's what the polls continue to show are on top of voters' minds. The economy seems to continuously be the number one issue, especially when it comes to inflation. And whether or not it's the latest New York Times Siena College poll or it's Bloomberg's poll with Morning Consult that focuses on these swing states, what you see in the data is that there is a trust deficit amongst voters with the Biden administration. So you're going to see all these GOP candidates want to attack the current administration when it comes to the handling of the economy. They're going to want to talk about cutting spending. Where they want to cut is, of course, a small slice of the pie, right? No one's going to want to talk about cutting defense, and no one on that stage is going to want to talk about cutting entitlements. That does not garner good views from voters. One thing, though, Lisa, that could potentially separate some of the individuals on the stage, and we saw Governor and former Ambassador to the UN Nikki Haley do this, is some will potentially start to attack the Trump administration for raising the deficit by nearly $8 trillion as well. So I think that will kind of be a marker. Who is willing to go after what the Trump administration did in terms of the deficit as well, and not just go after the current policies of the Biden administration?
Emery, are people still saying that it's almost a certainty that the matchup next year is going to be Biden-Trump?
It does feel like more and more people are coming out and saying, this is the election we didn't want, but this is the election that is forced upon us. Most voters in the polls want to see fresh, younger faces, and it looks like they're just getting a redo of 2020. But again, we are a year out, and there's still a lot of debates, caucuses to go. Potentially, it can change on the Republican side more so, not on the Democratic side.
Anne-Marie Herder, thank you so much. As always, we've been talking all morning about where we are economically and whether the Fed is responding to an actual slowdown or whether it's going to be a head fake, given that we still see inflationary pressure and we might see a patch of softness leading to yet another sense of strength as well as inflation early next year. One of those people who thinks that perhaps this might be a head fake is Veronica Clark, economist at Citi, who joins us now. Veronica, how much are you pushing back against some of the optimism that we've seen in the rip-roaring rally in the Treasury market last week?
Yeah, I mean, I think the rally that we've seen is a response to policymakers last week. Of course, we had the Fed and the Treasury. But what hasn't changed is, we really haven't seen much in the economic data that have changed. It was just a couple weeks ago where we got almost 5% GDP growth in Q3. We did have an employment report on Friday where there was a bit of a downside surprise, a bit of an increase in the unemployment rate. But overall, it does still look like pretty resilient activity, and especially, unfortunately, for the Fed, pretty resilient inflation also.
So, Veronica, when you say that the data isn't as soft as people expect, how do you push back against, for example, the labor market report that showed significantly fewer jobs than people previously thought, as well as several consecutive reads of jobless claims going up at a faster pace than people expected?
Yeah, the overall headline miss to payrolls I wouldn't read too much into. We do know that there were about 30,000 striking auto workers that dragged on payrolls this month. Those will be added back to payrolls in November. I'd say the most interesting thing maybe on Friday's data was that we have seen a rise in the unemployment rate over the last 6 months or so. We could look back, if we're in a recession this time next year, we could look back and say maybe this was an early sign of it. But I wouldn't read too much into that now. The level of the unemployment rate is still very low. We are definitely watching the claims data. We have had this increase in continuing claims. There are some seasonal adjustment issues with that series, and the fact that initial jobless claims are still very low is, I think, more important, but we're definitely watching those initial jobless claims.
Do you think that the Fed is making a policy error then?
Yeah, it's really hard to say at this point. I mean, we don't think we're getting any more rate hikes from the Fed, but we could get into a couple months of data now where we've had softer inflation data June, July, August. We've had one, the September CPI print where the details of that were pretty strong. We think we're going to get some pretty strong underlying details of upcoming, 3 or 4 months of inflation data. It could look pretty uncomfortable maybe early next year. It just doesn't look like inflation is sustainably slowing at this point. But I think as you're leaving rates high for a while, at some point that should matter and should slow things down.
We're speaking with Veronica Clark of Citigroup, and this has been a view that you guys have held for quite a while, and you've actually switched your view on the Fed recently based on some of the recent rhetoric saying that you don't think they are going to hike rates again. What gives you confidence that inflation is going to pick back up given that consumers are clearly showing a strain and they are selectively moving away from certain areas and pushing back on the margins against prices going up too much?
Yeah, I mean, fundamentally, I think the underlying resilience of inflation has to do with the labor market. And we did have employment cost index data out last week. Also, we had a lot of data last week. And that is still running, wage growth is still running at a pace, somewhere around 4 to 5%. That's going to be more consistent with something like, 3% inflation, 3 to 4% inflation than 2%. So I think that's fundamentally it. But in the upcoming, couple months of data, we do a very detailed, component by component forecast. And there is probably some strength. We're not going to get a drag from used car prices as much in the next couple months. Things like airfares that could look a bit stronger. All of that to say, we might be exiting a soft spot for inflation in the next couple months.
Which raises this question of what will break. If the Fed isn't going to raise rates further, as you now believe, does that mean that inflation is going to stay sticky and higher than the Fed would like and get less sort of grounded than it has been so far? Or are you saying that something will crack in the meantime?
Yeah, I think it's actually both of those things. I can see inflation staying high until we get the real recession in the U.S., a real slowdown. And that can come from, rates, are at restriction, contracted levels. I mean, that's probably true. At some point, leaving rates, in that territory for longer is going to weigh on activity. We would have less confidence in the real soft landing. I think that, drag on activity does look like a recession at some point, and that's what breaks inflation finally.
At 2 p.m. today, we get the SLOOS, the Senior Loan Officer Opinion Survey, which a lot of people looked forward to 3 months ago. And now people are basically saying, well, we haven't really seen credit tightening at some of these smaller banks to the extent that we thought that we would. Are you expecting that this report will show something different and that this maybe was why the Fed had a different tone at last week's meeting?
Yeah, I've heard some conspiracy theories that maybe the Fed knew something in the SLOOS that we don't know yet. I think it'll probably show that, credit conditions are contractionary. People don't want to borrow, people don't want to lend. And over time, that is what weighs on activity. I don't think we're going to see anything too shocking necessarily, just more of the same. And, as, credit conditions are tight, at some point that will matter.
Veronica Clark of Citigroup, thank you so much for being with us, as always. And here with us, our SLOOS correspondent, Michael McKee, who is going to cover all things regional banking. SLOOS correspondent. I know that you have coveted that for years, and so I want to say congratulations for being promoted to the SLOOS correspondent. But I'm curious how important it is at a time where there's very little other data and where people seem to be clinging to narratives that change like sand sifting through some kind of timer. I'm coming up with a terrible analogy.
It's a quarterly report, so we haven't heard from the bank folks since basically July. We'll get the new SLOOS today, Senior Loan Officer Survey. But it doesn't really matter because the Fed's already got it, and they've already acted on what they have seen. Raphael Bostic spoke with us on Friday, and we asked him about it because they had already seen it, and he wouldn't give us the details, but he said, I don't need to read. He said, I read it, but I didn't learn anything because bankers have been telling me for weeks now that they have been tightening credit. So you could assume that the SLOOS today is going to show tightening credit.
So John was asking me earlier this morning, are we going to hear anything new from Fed Chair Powell? Is he going to actually say anything? Does he want to say anything? Does he want to push back against essentially a loosening in financial conditions that we've seen over the past week? Do you think that we're going to hear anything?
I don't know that we'll hear anything definitive. The market reprices on a moment-to-moment basis, so we may get something that sends bond yields up or down. But it doesn't really matter because we're 6 weeks away from the next meeting, which is what a number of Fed officials have said on Friday, basically, when they started doing their rounds of TV interviews and speeches, is why do we need to tell you what we're going to do now when we've got 6 weeks, 2 CPI reports, a PCE report, and another jobs report coming up? Let's just wait and see.
Michael McKee, stick with us, our SLOOS correspondent, saying things like we may get something that sends yields up or down, which is sort of how it feels because we don't know which direction a given day is going to be a violent move one way or another. Right now in the market, you can see the earlier rally in equities pull back just a bit, but still around 0.2% gain. The euro gaining versus the dollar weakness really standing out. And earlier this morning, we were taking a look at the potential for gold to rally. Chris Verone was saying that is an indictment, frankly, on the attractiveness of some other currencies. And 10-year yields right now, I'm looking at an increase of more than 4 basis points, 4.61%. Michael McKee still with us here as we parse through the lack of economic data this week. We also do get from a whole host of Fed speakers. Do we have a sense of whether they're okay with the action, the sort of violent volatility that they have seen in benchmark yields? Is that actually helpful in and of itself, just simply because there is a dampening in risk appetite that comes along with such volatility?
Yeah, I think you put your finger on something that may be slightly important to the Fed, and that is the idea of the dampening of activity because of the volatility may cause people to pull back a little bit. But you want a good indicator of what the Fed is thinking, look at the fail rate for trades. And if the fail rate doesn't go skyrocketing, then they're not going to worry because it's not a systemic issue. The idea that the market was doing the Fed's work for it had some nice credence for a while, and now it doesn't necessarily. But do we know where bond yields are going from here? You look at the story on the Bloomberg this morning, fascinating story, about how much of this rise in bond yields that we saw over the last month was due to massive hedge fund shorting. And so that's the kind of market thing the Fed can't do anything about, can't plug into their models, so they'll just look through it.
Do you think that they're going to be watching the auctions, the $112 billion of Treasury auctions this week?
They'll be watching. What's funny is, to me, is that we're seeing this enormous, there's $330 billion worth of Treasuries going out, another $40 billion, they say, in corporates. And everybody's saying, who's going to buy this stuff? But nobody's saying that nobody will.
Right.
It'll get through somehow.
It'll get through. It's just a question of what price it'll take. Michael McKee, thank you so much for being with us. Coming up, Ashley Allen of Franklin Templeton on the state of the consumer, a key question as we look to next year.
Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen between now and even the next meeting.
That was Raphael Bostic, Fed president of the Atlanta Federal Reserve Office, speaking with our own Michael McKee last week, just taking a look at what's going on in markets, a little bit of lift. Remember, last week was the biggest rally that we've seen in equities so far this year, one of the biggest rallies we've seen in bonds, very much a cheer based on the fact that maybe the Fed was not going to raise rates even more from here. Just taking a look at some specific stocks on the move. Bumble, the dating app, is moving downward, lower by more than 6% after the CEO, Whitney Wolf Hurd, said that she would step down from this company. She did found it. A real question around dating apps and how much more popularity they can gain given the boom that they saw over the past 5 years. Now questions around consolidation, et cetera. Hilton, those shares are kind of fluctuating back and forth, now up 0.4% after announcing an agreement to buy Blue Green Vacations, basically valuing this company at full speed, including all sorts of other potential premiums, 111% premium over Friday's stock's closing price. And Birkenstock, those shares lower by just a touch after HSBC analysts said that the valuation, quote, feels a bit tight, unlike the shoes, which typically are quite loose. But I digress. Moving on. Joining us now, I'm so glad to say, is Ashley Allen, corporate credit research analyst at Franklin Templeton, who can weigh in maybe on Birkenstock. But more importantly, thank you so much for being here, because to me, the big question really is how resilient is a consumer after people have been saying that they're running out of their savings month after year after month. Have we reached a point where you actually are seeing evidence of that?
Maybe. And I think it's been maybe for a few months, to be fair. But I think we find ourselves in a really interesting situation right now, especially following 3Q earnings. We just heard from a handful of staples companies, from restaurants. Consumers are still spending, especially on some things that they'll want to indulge in, whether it's coffee, sweet treats in the grocery store. So the data is backward looking, so we have to keep that in mind. But up until this point, again, resilient has been the word that economists have said over and over. They're still showing up to spend on the things that make them feel good.
How much in some of the earning calls that you've been tracking and just some of the communication that you've had with corporate officers about what they see going forward, how much do they see this continuing in a durable fashion just based on how much wages are increasing and the fact that the labor market is strong?
I don't think it's durable, at least at the same level that we have sustained thus far. A lot of the resilience that we've seen on the top line has been driven by price. Volumes, let's call them flat, plus or minus, on either side, both in kind of the restaurant space, but also in staples, if you think about the CPG companies in the grocery store. Volumes have kind of flatlined. So where they can, consumers have technically been pulling back. From a volume perspective, they're consuming less. Companies have just realized that they can still benefit from taking price. That likely can't continue forever. going forward.
Well, a lot of people will argue that a lot of the household balance sheets look pretty good.
They do.
So if people want to lever up to get a latte, a double, mochaccino, they can do that. Is that what we're actually seeing, that people are just continuing with indulgences but levering up to do so?
Potentially. I don't necessarily, it's always a maybe, right? I don't necessarily think that they're leveraging up to buy their latte, but I think if you have to look at the bigger picture macro, if you think about millennials, broadly speaking, who maybe are waiting to buy their first home, if you can't do that right now, I would argue that, spending $7 on a coffee isn't going to impact your ability to buy a home the same way the Fed would in regards to their rate policy. So I think from a consumer perspective, it's less so about them leveraging up, but a bit more about the bigger macro picture, what they are spending on, and how they're supported by jobs, to be frank as well.
So as an investor, do you recommend then consumer discretionaries that are the small luxuries in life that people seem pretty committed to?
Yes, so there is something called the lipstick effect, which we've seen before, specifically, in regards to beauty, where women will still spend on small luxuries to make themselves feel good during times of economic stress. I think that same the pattern or thesis could easily be applied to sweet treats. So think about, Oreos or cookies that we like as well as just the occasional splurge in regards to dining out. And whether that's at a full price restaurant, maybe you're okay spending $20 on your fast food meal that one time. They will indulge, especially during times of economic stress.
Do you buy the whole Ozempic argument?
Not yet. It's TBD. I do think these drugs are really powerful for the individuals that they were originally designed to help, maybe those with type 2 diabetes or who are severely overweight and obese. But consumer habits really die hard. And I think that it might take more than Ozempic, at least in its current form, to change those patterns.
So zooming out, we were just speaking with Veronica Clark over at Citigroup, and she was talking about how they expect a soft patch now and then a reacceleration in inflation because a lot of consumers just keep accepting prices where they are. Do you agree with that, just based on sort of a company-specific kind of analysis?
I think that if consumers, can keep their wage gains that we've seen recently, if those can be persistent, there's a good chance that they will continue to accept the price gains. I think it's a matter of who's going to blink first. Is it the consumers or is it going to be the corporations in regards to pulling back on price to drive volumes, or are consumers finally going to reach a point where they say, hey, you know what, I don't want to spend $6 on a box of cereal anymore. I don't want to buy that $7 coffee. But as long as they're supported by jobs and some wage gains, I think, they'll continue to spend.
Which raises this question, when you talk to corporate executives and they can pass along these costs, are they then hiring more people?
No, because at the end of the day, corporates are also responding to markets, broadly speaking. They're trying to recover the margin that they lost over the past 18 months or so when inflation and input cost really got out of control. Margins became compressed at that time. Profitability was hammered. They've benefited these past few quarters from those price increases in conjunction with falling input costs. Now, to be fair, those costs haven't completely reverted, but profitability has been strong from them. And for the most part, this is very idiosyncratic, but companies have been rewarded when their bottom lines, of course, have expanded or reverted to pre-pandemic levels.
So just zooming out, to wrap this all up, I guess, there's this question of whether some of the legacy retail companies and whether the legacy service companies can continue to operate and thrive based on their capital structures and a borrowing cost that was a lot lower from another era that they were going to have to refinance at a higher rate, whether they are still credible companies to invest in a current environment. Are you basically saying that yes, because they're able to pass along those costs to consumers that have continued to really go for the products that they're selling?
Yes, they've been able to pass along the cost, but the maturity wall, broadly speaking, has been pushed out for several corporates, including those in retail, in discretionary names. And so, they have balance sheets these days and the cash flow to support, the interest expense that they have now. In 3 or 4 years, when their maturity wall comes due, we'll see where we are and we can address it at that time. But at the moment, balance sheets are strong, the cash is coming in, they can make their payments, and they're passing along those higher prices.
What are the strongest segments of retail right now?
Oh, it's a great question. Broadly speaking, beauty is a segment that's continuing to do well. Historically, pet has been a segment that's been strong, but we have seen some weakening there. It's probably a bit of a post-pandemic trend that's reversing, but
people are sick of spending their entire paycheck on Fido. Ashley Allen, thank you so much of Franklin Templeton. We really appreciate that. One of the biggest questions really going forward as we try to understand how much we can continue a trend where people can splurge and continue paying up on some of these prices. To weigh in on all of that, coming up on Bloomberg Television at 4:30 p.m., Dirk van de Put, Mondelez International Chief Executive Officer. I'm sure that he will have plenty to say also about Ozempic and how much that's really going to challenge their balance sheet going forward. There's been quite a bit of pushback that maybe people have overplayed just how much that's going to change people's trends. Right now in markets, you are seeing a bit of a pop, continuing the rally that we saw last week. Yields, though, are inflecting just a touch higher, which raises this question: have we truly seen the peak, and are we going to see stability, especially with $112 billion of Treasury auctions, 3s, 10s, and 30s this week? On Thursday, we do hear from Fed Chair Jay Powell. Right now, that euro strength is softening just a touch, coming back 107.36. And we are seeing a bit of a lift to crude, but this has been one of the most unpredictable areas of the market in the face of a conflict that does continue in the Middle East. Crude prices up about 1%. From New York, this is Bloomberg.